cautionary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
It can be the case that it's appropriate sometimes to look through inflation if it's transitory, and that can be the case in the case of tariff inflation.
Everyone's relieved that the Fed didn't jump to significant conclusions.
If we get to that May 7th meeting and they do not find a reason to cut rates, they're not going to find a reason to cut rates this year.
I don't think there's any chance that they cut in May.
The question is how much of a growth deterioration needs to occur before the Fed can react, and it seems to be that the bar is pretty high for that.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
I really don't remember the last time we had this much debate about how to interpret a central bank decision from the Federal Reserve, but we had tons. For this market, though, it was absolutely convinced yesterday that it was bullish. Equities off to the races, rocketing higher into the close. We were gaining by something like 1% on the S&P 500. Session highs, we were pushing even higher than that in the middle of that news conference. This morning, we pulled back on the S&P 500, just a little bit softer by a third of 1%. On the NASDAQ, down by 0.5. The next hour is all about the economic data. 29 minutes from now, we get jobless claims. Jobless claims in America, 8:30 Eastern time. For now, though, we need to talk about another central bank decision. And this time, Lisa, it's the Bank of England. Interest rates unchanged at 4.50.
Yeah, as expected, with 8 voting for this and 1 dissent. This really is a fascinating decision because of its lack of interest, frankly. How much it's the same as previous iterations. Rates are on a gradually declining path. The Bank of England says a gradual and careful approach to easing is appropriate. But this is fascinating, moving in the opposite direction, raising their first quarter GDP growth forecast to 0.25% from 0.1%. So you will see this moving in the opposite direction in a very confusing mix of trade headlines.
Let's head down to the Bank of England, just outside of Threadneedle Street, across the road from the Bank of England. Joining us now is Lizzie Burden from the City of London. Lizzie, welcome to the programme. Just break down how the vote shaked out in the end and what you're looking for in the headlines.
Well, John, as expected, this is a hold. It's interesting that it's an 8-1 vote split. Catherine Mann going from Archhawk to Archdove, voting for a jumbo cut, and today for a hold. So completely changing her tune. But in recent weeks, she has been emphasising the need to keep policy restrictive and echoing the theme across the Monetary Policy Committee that caution needs to be the watchword here because of all of the uncertainty around tariffs and trade policy coming out of the US, and then the second round effects of that on inflation expectations and wages and prices here in the UK. It's interesting as well, Lisa, that you pointed out that growth forecast upgrade. I am sure that that is going to be very, very welcome over on Downing Street. The Chancellor, Rachel Reeves, preparing for her spring statement next week, and of course growth, the Labour government's #1 priority. But as well, interesting that they've maintained that guidance that the rate path ahead is going to be gradual and careful. So not a lot of change here. No press conference today, no forecasts, and pretty much what was expected.
Lizzie, that spring statement taking place on Wednesday next week at a time when the Germans are easing fiscal policy and easing things potentially aggressively in the coming years. How much space does Chancellor Reeves have in the coming 12 months?
Put it this way, John, Britain is broke by comparison to Germany. Rachel Reeves does not have the same set of options that Germany has when it comes to increasing defence and infrastructure spending. I was speaking to her on Monday, and interestingly, we had a conversation about her headroom against her fiscal rules. She left herself a razor-thin margin back in October. That's been wiped out now pretty much because of the gilt yield moves. And she emphasised heavily, actually, the need to build up that fiscal cushion again. And that's been confirmed by our colleagues on the Economics and Government team, Phil Aldrich and Joe Mays, that actually she is going to leave or even build up that £9.9 billion headroom. It comes, though, from spending cuts, which for many harks back to the Conservatives. And to me, what's fascinating about that is it seems like she's more concerned about the bond vigilantes than she is about upsetting the left wing of the Labour Party.
Lizzie, appreciate the update. Great work as always. Lizzie Burden, outside of the Bank of England in the City of London. A few headlines to go through. I'll share them with you now if you're just joining us. 4.50, the interest rate at the Bank of England. Bank rate remains unchanged. The vote, here's the breakdown for you. 8 voted for no change, 1 voted for a quarter-point cut. The approach, let's talk about the approach from Governor Bailey. He says the approach will be gradual and careful, but interest rates are on a gradually declining path. That's the Bank of England this morning.
Yeah, and upgrading the growth forecast to 0.25% from 0.1%. I will just say that one terminal user messaged in, it's like wanting an ice cream sundae and your mom gives you a baby bite of vanilla ice cream. Not enough, because 0.25% isn't something to really celebrate still. I thought that was notable since it was in the opposite direction of what everyone else is
Someone's
doing.
tortured childhood. Is that a terminal subscriber?
All I can say is I relate.
Isn't it like being promised a banana and actually getting some ice cream?
Well, I mean, look.
Isn't that the growth forecast?
Thank you. I think that that is the correct way to look at it, because ultimately it is welcome. It is the opposite direction, and frankly, on Downing Street,
there you go. We'll take some of that.
I'll take a little taste of ice cream. It's sweet.
Love some ice cream. Right now, anyway. Equities right now in the S&P, down about 1/3 of 1%. This morning, as Fed Chair Jay Powell downplays inflation risk, Greg Bowdle of BNP Paribas writing, we see the driver of the market switching from systematic to discretionary flows. If the market bounces, we think it could be a shallow bounce and one to fade. Greg joins us now for more. Greg, good morning. Good to see you. We're fading that bounce. We're fading it this morning. I got faded pretty aggressively in the last couple of hours or so. What did you make of yesterday? Let's start there, and then we can go through the rest of the stuff.
Yeah, I think it was a relief rally for equities that we didn't get anything from the Fed that I think really changes the bigger picture for equities, but neither did we get anything that was negative. So, our view is that we could have a bit of a relief for equity markets this week, as some of the positioning got very washed out last week. And I think the absence of anything negative from the Fed was really seen as a positive.
In the forecast, though, to put out forecasts and downgrade your outlook for growth to the extent they did, and to not see the median dot move lower with it, in fact, to see the distribution of the dots have a more hawkish skew, that can't be bullish, can it?
No, I don't think standalone that's bullish for equity markets, but I'm not sure how much of a surprise it was for the market either. Concerns around growth have certainly picked up this year, and to hear that kind of reflected by the Fed, I think, is a little bit more of the narrative that has given U.S. equity markets a troubled start to the year.
Before we try to understand the mystery that is a confused and in-the-dark Fed, I want to understand positioning and where we are in the sort of unwind of the trade that had been the momentum stocks. Are we done with that? I mean, if we wash that out, now we're responding to the concepts of stagflation and what kind of response we could end up getting from, say, the Federal Reserve.
Yes, the way that we think about these things is in different stages and different buckets of investors. So when we look at positioning, we can split that into things like systematic investors, long-short hedge funds, and more directional investors. And what we've seen is certainly that systematic part of the market looks very washed out. So we saw some huge outflows from CTAs, volatility target funds, levered ETFs that we think were more than $100 billion of outflows over the last month. We think that those are largely washed out, and there's a more benign outlook for the next couple of weeks. Now, what that doesn't answer is the bigger question of what are discretionary investors going to do? What do they think about the growth outlook? We saw huge inflows into equities at the end of last year. So the question is whether it's the corporate picture or the macro growth picture has enough change there to drive those investors to change their behavior. The answer is not yet.
If there's an international ball of money and it's kind of washing around to different places where it thinks that it's going to be treated best, does the Fed cutting rates potentially by 25 basis points in the face of truly weakening growth entice that ball of money to the United States?
I don't think so. The question around how the market reacts to the Fed is always, why are the Fed doing what they're doing? So if you have a modest slowdown in growth and you have a deep cutting cycle from the Fed, that's something you think would be bullish for U.S. equities. Whereas if you have a shallow cutting cycle from the Fed because growth is deteriorating, then that's less bullish.
What would be the catalyst for the market to really start to rally?
So
you say it's about a confluence of all these issues, which we're not really going to have any solutions to, at least in the short term.
Yeah, that's kind of the thrust of how we're looking at the market in the short term, is that you can have a relief rally if the news flow from the Fed is better. You can have a relief rally if the feedback from the NVIDIA event this week was a little bit better. But if we're worried about trade, tariffs, fiscal uncertainty, monetary uncertainty, growth slowing down, the consumer, it's hard to see all of those things kind of alleviate, or the concern alleviate at the same time. This is why we think we can have these kind of pockets of relief rally, but it's very hard to see the market go on a kind of sustained move higher to make new all-time highs without really seeing a lot of things change in terms of the outlook.
What would the market need to hear on April 2nd in order to have maybe a sustainable relief rally?
So I think anything which kind of calms people's expectations that tariffs ratchet and we have further retaliation and it becomes this kind of tit for tat. But I think that even if we saw something that calmed the markets regarding tariffs, to the point, it's not going to clear the decks of everything the market's worried about. We're still going to have to get through the next corporate earnings season. There's some signs of slowing there. We're still going to have to address some of the issues that have weighed on large cap tech this year. So I think confluence of events is why we think it's hard.
Let's get to the earnings. I'm pleased you brought it up. Delta Airlines in the last few weeks, I think it's probably one of the most important data points we've had. It's not just soft data. The CEO, Ed Bastian, of the company are coming out and saying Q1 won't be anywhere near as good as we thought it would be because consumer and business activity stalled in the middle of February. Can the hard data get any harder than hearing that from Delta?
Yeah, so I think one of the things that ultimately we think is always most important for equity markets, away from policy, away from macro, is always going to be the corporate earnings. If you see corporate earnings disappoint, it's very unlikely that the equity market's going to do anything other than have a tough time. And I think when we look at this earnings season, it's notably been a more challenging one, the prior earnings season that we've been through, than what we've become accustomed to. And I think that's been broad-based. So some of the kind of cyclical bellwethers, things like Delta, but we also saw some downgrades in some of the more secular growth stories at the start of this year as well.
How do you judge whether they're just sandbagging us? And I say this because, no, I'm serious, because they talk about transitory. I think it's transitory, but we're going to really lower the bar so we can jump across it later. I mean, how much is that part of what's going on? And, you know, I say that partly because how can we really judge an outlook that's based on the dark room that we're all in blindfolded?
Well, I think the real answer is that we can't. And whether it's trade, tariffs, monetary policy, John's questions on earnings, it's more questions than it is answers. So this is why we think we're going to be in this environment where it's heightened uncertainty for equity markets, which drives more volatility, and it makes it much harder to sustain a rally. We think hedging is something that investors should be very focused on at the moment.
I don't think Delta's a forecast, though. It's realised. They're telling you what happened in February. That's the difference here. You can say, okay, I don't believe your outlook, you're sandbagging us, you're lowering expectations. Perhaps they are. We've seen a lot of that from the retailers, and we'll talk about Nike on that front in that regard in just a moment. But with Delta, they told you what happened in February. So the softness, the weakness is not just survey data. They're seeing it in actual activity.
Yeah. The only caveat to that, and I'm with you, I'm 100% on the Delta was the biggest data point probably of the past month. The one caveat to that is it's not falling off a cliff to that extent.
It's true.
And so it's not that people aren't traveling, it's that it's seen a significant downdraft. And he said that he expected that to be alleviated when people feel good again and then just need a vacation. So, you know, there is that.
We're always on the same page. For equity markets, though, think about this. So GDP's come down from 2.5% to about 1.5%, and we've repriced GDP forecast in, the space of a month? So we've come down almost 1 full percentage point compared to what the street was looking for at the start of the year compared to now. Now, I want to understand from your perspective, Greg, just to wrap it up, in a world where you're downgrading growth that way, do earnings typically come in a way that supports equity markets?
No, I mean, like the simplest thing is to look at like nominal GDP growth relative to earnings, and the two are pretty well correlated. So if you're bringing your growth forecast down, it's unlikely that you're taking your earnings forecast up.
Have we brought our earnings expectations down sufficiently to account for that?
No, I think earnings forecasts have come down somewhat, but they've retraced from what were pretty optimistic expectations at the start of the year.
Greg Battle of BNP. Greg, appreciate it. Thank you, sir. Lots to think about, I know, and there's so many different conflicting data points that we all need to grapple with in the coming weeks.
Your point is a very smart one. Either earnings expectations have to come down or those Wall Street firms have to go back to the revisions and revise them again back upwards. But something has to give because that delta's getting wider.
This is what this equity market's been responding to, all of this over the last several weeks or so. Futures right now down by about 0.4% on the S&P. Let's get you an update on news elsewhere with your Bloomberg brief. Here's Yahira Hakez. Hey, Yahira.
Hi, John. Turkish markets are showing signs of stabilizing after authorities stepped in to offset demand for dollars following the detention of President Erdogan's main political rival. Because of this, you are seeing the lira recover against the dollar, while the main stock index rose 1.1% today, but as you can see, still has not recouped all of its losses from yesterday's plunge. Meanwhile, Canada's foreign minister says China has executed 4 Canadians holding dual citizenship on drug-related charges this year. The executions further straining ties between the nations, with China saying Canada should respect its laws and not interfere with its judicial sovereignty. And the White House is considering extending Chevron's license to pump oil in Venezuela, reversing a recent push to have the company wind down operations next month. The Wall Street Journal reporting Chevron CEO Mike Wirth met with Trump at the White House yesterday as part of a larger gathering of energy executives. That's your Bloomberg Brief. John?
Ira, thank you. Appreciate it. Up next on the program, the Morning Calls Plus. Brooke Roach of Goldman Sachs ahead of Nike earnings after the closing bout. That conversation up next. Live from New York City, that opening bout 1 hour and 15 minutes away. Equity futures just a touch softer. We're down 0.4%.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizon's Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onim, only on Bloomberg.
The opening bout just around the corner, 1 hour and 13 minutes away. Equities a little bit softer compared to the rally that we got yesterday going into the close. In that Fed meeting, unleashing a 1% rally on the S&P 500. The S&P this morning down by 0.4%. The Nasdaq down by 0.5. Let's get you some morning calls. First up, UBS upgrading Southwest Airlines to neutral, noting the potential for improving financial performance. That stock is higher by 0.6%. Your second call from Piper Sandler, downgrading Rivian to neutral, warning the EV maker is exposed to a, quote, potential triple whammy of policy risk. That stock is down by 1.85%. And finally, Morgan Stanley lowering its price target on 5 below to 110, saying tariffs present a significant margin headwind. That stock this morning still just about positive. It's up by 9% in early trading. Let's stick with retail. Investors looking ahead to Nike earnings for another read on the state of the U.S. consumer. Brooke Roach of Goldman Sachs writing, we believe it is still early in Nike's turnaround journey, and we have yet to see material signs of brand heat improvement. She has a buy rating on the stock with a $90 price target. Brooke joins us now for more. Brooke, welcome to the program. Let's get into it. What are you looking for later on today?
Good morning, and thank you for having me today. We believe that all eyes are on Nike's earnings result this afternoon. And as we look to the report, we do believe that focus is centered on signs that the brand turnaround is working. New CEO, Mr. Elliott Hill, outlined several strategic actions taken to improve the brand over the course of the past couple of quarters. And we believe that you're starting to see signs that those actions are taking root. We have seen some refreshes in marketing. We've seen some changes in promotional activity, and we've seen some signs that they're looking to reduce discounting on Nike.com. As a result, all eyes are on any signs that fiscal 26 may be able to return to growth and what the impacts of recent changes might have on sales growth and earnings.
What's the growth market, Brooke? Is it going to be the United States? Is it going to be overseas at a time where there's real question about that? Will it be trying to rehitch its wagon to the NFL?
I think one of the big questions is whether or not they will be able to return the North America market to growth. We believe that the reset in North America is very important. We are seeing signs of improved marketing. We are seeing signs of improved innovation. And we are seeing some signs that the North America consumer is engaging with that improved marketing and innovation. Generally, in our sector, when markets begin to improve in North America for retail brands, we start to see signs that brand heat can translate internationally. So we believe investor focus will be very centered on North America.
The big counter argument is on holdings, is the potential increase in HOKAs, is the fact that in all the running groups that we all see in the morning in Central Park, there isn't necessarily a huge domination of Nike shoes. Instead, there are a whole host of other brands. At what point does that become a real problem? Because there are these competitors and they're scrappy and they're getting in.
We are seeing a lot of signs that Nike is refocusing on innovation across each of their core sport categories. The new CEO is focused on returning the brand to focus on sport and to engage with those core running communities and those core sport communities. As a result, we've seen better innovation with more new product. We've seen the launch of the Pegasus Premium and the Vomero 18. And the company is refocusing on engaging with those local communities and with specialty retail running. So we believe that they are starting to make the steps that are necessary to return to competitive market share positioning in each of those core categories.
Brooke, even if they have a better product, what's to say people are buying? Dick's Sporting Goods, they expect a sales slowdown at the same time that surveys continue to say that consumers are worried about the uncertainty that's coming from policy in Washington and the tariffs.
Overall, we have seen signs of some consumer slowdown and macro choppiness over the course of the last few weeks. At first, there was some focus on the potential that this was a function of weather, but overall, we have seen some more comments about slowing overall. I think as we look at Nike's turnaround story, investors are much more focused on what will happen in fiscal 26, which will be beginning in June of this year, and what Nike can do on a relative competitive positioning to improve that brand heat so that they can gain back that market share regardless of the macro backdrop.
So is basically what you're saying is 2025 is going to be really a period of transition for Nike to then potentially nail it in 2026?
We believe that the company will be returning to growth in the back half of their fiscal 26, and that many of the actions that have already been outlined by management are going to drive lower sales and lower margins in the first half of fiscal 26 and thus calendar 25.
There's a challenge still to come. Brooke, appreciate your time to break this down for us. As always, Brooke Roach there of Goldman Sachs on Nike. Nike so far in the month of March down 8%. You mentioned Dick's Sporting Goods down double digits so far this month, and that's the concern.
Because Dick's Sporting Goods is saying that they're seeing a sales slowdown for this year of 5 to 7%. So even if Nike had a product that everyone was buying, like you mentioned, those running shoes or HOKAs, people are pulling back and they're potentially not even buying it, let alone the fact that Nike's not having something that's really exciting consumers right now.
What this conversation did reveal, though, that there are some companies who are better than others to reveal where the consumer is at right now. This is one of those situations where if Nike comes out with weak earnings, and I've got no idea what the results will be a little bit later, but people will say there's structural issues, there's idiosyncratic problems with Nike. It's not a clean read on the U.S. consumer.
That was my takeaway as well. This is one that's been trying to reclaim its spot in the sports attire race, and it's having a hard time because the race has changed. Not only do you have these upstarts, you have resale platforms. You've got Walmart getting in on that in a massive way. You have all sorts of new ways of distribution that they've been playing around with in terms of, are they in stores, are they out of stores, how do they deal with this? And that's going to be challenging for them when you have others that are really making real terrain.
They slipped post-pandemic and they're struggling to get back up, that's for sure. Need to reset a little bit in just a moment at 8:30 Eastern time, so 6 or 7 minutes from now, we'll get US jobless claims. This is another read on the US labor market. I'll share the estimates with you. 224 is the estimate for claims. The previous week was 220, so we're not looking for deterioration in the headline number in just a moment. But every single week, as the fears about economic growth and potentially a downturn continue to build, that data point becomes more and more important.
And people will be parsing it more and more carefully to understand exactly where the layoffs are coming from and whether the stagnant labor market is starting to break in the wrong direction. One thing I'm looking for is continuing claims, because that is the people who are receiving jobless claims benefits over a longer period of time. That is expected to tick up to one of the higher levels going back several years. So if you start seeing that kind of trend, how much do people extrapolate out?
That would speak to the anxiety of the labour market right now. That people are worried about their ability to go and get a job if they're out of work. That would speak to that directly. We also saw anxiety around unemployment start to climb in UMich. Now, I think you could sit here and say UMich is not that important, it's driven by politics, but we've seen several echoes of that in other data points as well.
And also, even in this most recent UMich, they said across political demographics, most consumers were saying that they are feeling a little bit angsty and uneasy. What I care about jobs lately is what is coming out of Washington. How much is Doge actually cutting, and is it hitting the hard data, all the pronouncements we're hearing from Elon Musk?
The Beige Book, and you mentioned this, actually, because you actually read it this time and thought that it was interesting.
Blaming Anne-Marie.
I'm blaming
It
Anne-Marie.
got interesting this time.
Oh, it's always
usually
interesting.
beige. This time it was a bit more exciting.
What was it? Pink? Let me just tell you, I think it's always pretty interesting, but this time around it was actually especially interesting. And you pointed to the anecdote that I thought was really compelling, which is the stack of resumes on people's desks looking for jobs. That is a change after a long time where that labor dynamic was very different and speaks to sort of things becoming a little bit less balanced.
The psychology shifts quickly, doesn't it? I'm kind of pushing against that, just making sure that people just stand firm, stay strong, keep asking for more.
That's your rallying cry?
I just think that once psychology becomes informed that way, the leverage shifts even more aggressively.
Keep going with that.
Ask for raises.
Yeah, keep going with that.
Maintain your confidence in your self-worth and all of that.
Keep going. I love this.
I'm not going
to
to throw cold water on this. I didn't read anything. I was in bed at about 6:30.
Lucky you.
Up next on the program. Jobless claims just around the corner. Luke Tilley of Wilmington Trust joins us. Matt.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week.
Welcome to Balance of Power.
This is Bloomberg Television.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
The opening about 60 minutes away. Equity futures on the S&P down by 0.4%. On the Nasdaq 100 down by 0.6. In the bond market, just ahead of jobless claims, your scores will look like this on a 2-year, 10-year and 30-year. The 2-year is down by 5 basis points. The 10-year is down by 6 at about 418. A break of 420. We've got a gap lower on a 30-year yield as well. We're down by 6 basis points. With your economic data, let's cross over to Michael McKee. Good morning, Mike.
Good morning, John. Well, we are getting the first numbers in maybe from the Philadelphia Fed. Oh, here come the jobless claims numbers. 223, just below the forecast, just above what we got last week, which was 221,000. Now, the interesting thing in the numbers this week is that the number of people who are claiming federal unemployment benefits for the first time fell again to 1,066. 2 weeks ago, it was 1,600, and now all of a sudden we are seeing much fewer. And that may be because a lot of these people, if they are getting laid off, are getting some kind of severance, and they can't claim until that point. Continuing claims were, let's see, 8,215 last week. So a slight rise there, but basically we're not seeing a lot of the federal Doge layoffs having an impact. Now, Philadelphia Fed did come in higher than anticipated, 12.5. The forecast was for 9, but this is down from 18.1. And the thing that everybody is looking at on these regional indexes is prices paid. Prices paid go up a lot, 48.5 after 40.5 the month before. So still some inflation pressure, no problem with the labor market, and it seems like Mr. Trump's tweet is not going to affect anybody at the Fed given these kind of data.
I wouldn't expect it to right now. Mike, just to sit on the jobless claims number and compare it to continuing claims, are we seeing any subtle signs that once you're out of work, it's harder to get work?
Not really, not yet. It's slowly creeping up, but 1,859,000 last month, 1,892 this month. So it is getting a little bit harder, perhaps, but overall, it's still a sign of a labor market that is relatively healthy.
Mike, thank you, sir. Echoing what we heard from Chairman Powell pretty much directly in that news conference yesterday. So that's the latest economic data. Lisa, just to go through the bond market, yields are lower, down 3 basis points. The 2-year 394, the 10-year just a break of 420.
Yeah, not a huge reaction given the fact that we didn't really learn anything that we weren't expecting in this data. I do go back to this question about what the lag time is between the soft data and the hard data. This is something that Mohamed El-Arian has talked a lot about, that usually there's a 3 to 6 month lag. It seemed to be poo-pooed by Fed Chair Powell. Right now, the hard data is not showing us a real sense of alarm, even though the survey data is suggesting it.
And to Mike's point, what's the lag data for the Doge effect? Because you're not seeing it show up right now. And to his point, potentially a lot of these individuals that were laid off with the federal government got severance pay. So they might not be able to go and ask for a claim. When do we start to see that impact the data?
That's the latest on the economic data front. Let's get back to the chairman of the Federal Reserve and the decision of the last 24 hours. Luke Tilley of Wilmington Trust weighing in on that decision, writing the following. We continue to think the labor market and inflation data would justify a rate cut at the May meeting, but given Fed Chair Jay Powell's response, we are moving our first expected cut to the June meeting. Luke joins us now for more. Luke, welcome to the program. I want to build on what we heard just yesterday from Chairman Powell with you in just a moment. I want to start with the forecast, though. What was your initial reaction to the adjustment in the SEP that we saw relative to December?
Yeah, well, the big change, obviously, is to the GDP forecast and that coming down. And I think that incorporates what we had been expecting, is that the strength of the consumer at the end of last year was not really strength in the sense that the consumer keep powering the economy ahead. what we saw was really strong spending on durable goods in November and December. That was coming a lot from replacement purchases from the storms, and then also people getting ahead of tariffs. So there was a lot of people at the end of last year that thought the economy was just up and away, you know, in this sort of almost like a no landing scenario that was going to generate inflation. And of course, we've seen consumer spending come back down in January, retail sales down in January and February. And really, the more accurate picture is a consumer that is, you know, it's doing okay. It's pretty solid, but it's going to decelerate. And that's why I would expect GDP to come down. We've had a 1.8% forecast for 2025 for a while. So the Fed now is very close to that with their 1.7.
So, Luke, growth comes down, inflation goes up, and it's that piece of it that's interesting. So from a market perspective for investors right now, they want to know if this Federal Reserve is in a position to respond to deteriorating data if we do get that weaker economic data. Are they constrained somehow by higher inflation prints? What would you say to investors this morning?
Well, we've had the same story for a while now, and it's that the consumer was not strong enough to keep pushing inflation higher, nor was the consumer strong enough to take on increased prices of imports and drive inflation higher. We thought that basically if you raise the prices on imports, that they would start spending less on domestic services, like going to the movies or haircuts or restaurants or anything like that. So we really didn't perceive that there was an inflation problem. We've been messaging that for quite some time now. I think the Fed, in a good way, was talking very differently about tariffs yesterday than 7 weeks before, acknowledging that the increase, you know, a tariff increases the price of a good, but that's not necessarily inflation. It's only inflation if consumers can handle it and they're ready, willing, and able to keep paying those higher prices and keep spending elsewhere. And that's sort of what it sounded like at the end of January, the previous FOMC meeting. But of course, the messaging yesterday, as you pointed out earlier in the program, very different. Basically, a step level one-time increase in prices of those imported goods, but we wouldn't expect it to generate inflation that would go on.
Okay, so Luke, it seems like you're actually on board with that, and yet you think that the Fed took May off the table in terms of cutting rates, in part because they are looking at the hard data. Do you think that actually this increases the chance they're going to be behind the curve if you do think that the soft data is indicating a much faster pace of deceleration economically?
It feels a little bit like last year. I think we were probably the last people to take July off the table last year and say, well, they're not even really leaving the door open. And then when they got to September, of course, they cut by 50 basis points and they had to play some catch up. I think yesterday, it was in response to a direct question about May. And Chair Powell said, we're not in a rush, you know, and so that's about as clear as a Fed chair is ever going to get about we're not going to cut rates at the next meeting. So that's why we have to push our first cut out one more meeting. I also don't think it's hugely important. The economy is not going to hinge on 25 basis points over the course of 7 weeks. But as I said, and as you read in the quote at the beginning, I do think that the economic data will justify a cut by May. We're going to keep seeing slower job growth. We're going to see slower consumer spending. I think the inflation data will keep slowing down. So it'll justify that, but that'll be fine. As long as they're talking about it at the May meeting, that should ease financial conditions.
We have this near-term data, and John was talking about the Delta earnings and the call about how much demand has been dropping off. We've heard that same thing from other companies that cater to consumers, and raises this question, how far behind is the hard data? We don't see it in the jobless claims. We don't see it in a lot of other data points that have been coming out from the government. At what point do you expect to start seeing this in the data, or can you dismiss this as watch what they do, not what they say? And those two things can be very different.
Yeah, I'm definitely a fan of watch what they do and not what they say. And I don't really think we're looking for a deterioration in the hard data, signaling recession or anything like that. If you just look at year-over-year retail sales, year-over-year consumer spending, it's at pretty mundane, normal levels that we had in 2018, 2019, when inflation was not a problem. And I think that hard data speaks directly to that. The labor market's going to be a lot more interesting. You know, we think that the job openings are going to continue to decline and jobs are going to slow down. One of the interesting things here is that because of the uncertainty of the tariffs, we do expect firms to maybe hold off on hiring. And that dynamic, it wouldn't actually show them cutting their open positions. Just sort of, you know, hey, you know, HR, let's wait a little bit and see how these things turn off and not pull the trigger on actually hiring somebody. And that's where you would see it come through. So it's not going to show up in the JOLTS data right away. But one thing that we have seen, even though the job growth is okay, you're not seeing the unemployment claims, we're seeing shorter work weeks. It's 2 months in a row now that the average work week is really low. And when you combine that with slowing job growth and slowing wage growth, and you look at just total wages paid, that's at the slowest growth rate that it's been since the pandemic. So it's really starting to slow down, but it's like seeping in kind of sneakily because it's just basically lower wages being pointed out. You've got reduced overtime hours and that reduced work week. So in some ways, it is coming through in the hard data. It's not pointing to recession, but it is a slowdown, and I don't think generates any inflation pressure.
Luke, you have a recession probability of 35% and GDP of 1.8%. What I find so interesting about your call is it's the call you had around the time of the election next year. Meanwhile, everyone has really revised what they're thinking about growth and also potential recession because of the tariff story. What did you see in November that people are starting to catch up now?
Slowing labor. There was slowing labor demand all of last year. It's going to slow down the hiring. We're looking at job growth that is coming in at around 150, and you've also had a significant contribution from government jobs last year. So when you look at private payroll growth, it was slowing down already through the second half of last year. There were some strong consumer spending numbers, but like I said a few minutes ago, I think that those were a little bit of a head fake. And if you think about what's going to end up driving consumer spending, it's not savings. There's not many savings left. It's going to be job growth and wage growth. And when those things are slowing down, you're going to have a slower economy. It's going to fall down below 2% this year. That's how you don't end up with any inflation pressure. So I will say last year at the end of the year, it was incredibly hard to read through some of the impacts. There were multiple hurricane events, storm events, the election, people getting ahead of tariffs. So you really have to be looking at longer term trends and not hinging on one particular data point. But this is that slowing is what we've been seeing for quite some time, Anne-Marie.
A lot of people are catching up with you. Luke, appreciate it. Luke Tilley there of Wilmington Trust. Neil Dutta of Renmax saying almost precisely the same thing coming into 2025, saying the tariff blame game is overdone. There's more than just tariffs going on here.
There is a slowdown in the consumer after spending quite a bit. People talk about the slowdown in retail sales in particular as having to do with just how much they spent last year. But also, people have been traveling everywhere. People have been spending everything. And at a certain point, it seems like this year is sort of the sobering year. The sobering
post-pandemic hangover.
I feel like that's what's happening. I think so.
This is what Neil and the administration talks about. There is this hangover. And before the tariffs came into the play and center stage, you already saw a slowdown. There was weakness in the economy. But now, what Neil would say is this isn't a lazy excuse for economists and analysts to use the tariffs as the reason why they may have to really look at their growth outlook and rate it downwards.
There's a difference between a hangover and a detox, though, right? Not to go too deep here, but ultimately the administration's talking more about a detox.
That's actually a really good point. A hangover is a temporary sickness that is sort of induced by your
hair of the dog if you're that way inclined,
exactly.
You know, like wake up and
yeah, like on. You've had any experience with that whatsoever. But detox is a longer process that takes effort and
speaking with someone with experiences after the hangover, you are hoping you get a detox.
I don't drink. You all know that. Matt Britt of Invesco writes this. Balance sheets are strong and the macro environment is supportive of risk-taking, yet forecasting the remainder of the year has a wide range of outputs. Matt joins us now for more. Matt, welcome to the program. We've also had a bit of a valuation reset in financial markets as well. An important question to ask, and we asked this at the start of the year. What's our capacity to absorb bad news? Has that improved? And does that bode well for markets for the rest of this year?
Hey, good morning, everybody. And yeah, we actually had asked ChatGPT for a catchy phrase for this market that we're in, and it came out with inflation hangover. So you guys are definitely onto something there. So, you know, as for markets and credit specifically, we've gone wider. So we've adjusted on a valuation standpoint from very tight levels to more moderate, but they're still rich. But if we were to go into recession, you know, credit levels will have to adjust significantly wider from here. So, you know, you talked about 35% chance of recession. That's generally where ours is as well. But the tail risk is certainly fatter than normal. However, you know, balance sheets are in really good shape because companies were expecting a recession for the last 3 years. So everybody's been calling for a recession in 2022, 2023. They kind of gave up on it in 2024, and now we're back at it. So the good thing is they haven't levered up, and so we're in good shape. So I think there's ability for companies to absorb it, not really so much ability for spreads to absorb it because they're already on the tight end of the range.
Which is the reason why a lot of people were surprised, a lot of people being myself, that credit spreads have continued to tighten on these sort of stagflationary mixes, stagflationary light mixes. They're not actually stagflation. And yesterday we saw the same, in particular with high yield contracting yet again. How can you explain that?
So I think if you go back 5 years ago, you had almost to the day. So I remember March 23rd, 2020, you had the Fed step in and start buying corporate credit. So I remember the date because I could leave my office and leave the fetal position for the first time in about 5 days because it was so bad. The Fed stepped in there, and it was needed at the time. And we've had a lot of talk around, is there a Trump put? Is there a Fed put? And what I heard from Powell yesterday is that there is definitely a Fed put that is out there if needed. And they basically told you, or Powell basically told you, I am willing to cut even if I see inflation tick up, because if the economy is slowing, I think that's the more important thing, because I think the inflationary pulses are going to be temporary rather than the slowdown, which could be more severe. So with the Fed telling you that, I think that the tail risk got cut a little bit yesterday, and there's yields where they are. People want to buy. They want to buy. They just need a reason to buy. And Powell stepping forward yesterday gave you a little bit of calmness that he will be there if things get bad, just like he was 5 years ago. So I think that gives you the confidence. But, it's still not all the way there. There's still a lot of volatility. But overall, I think people will buy on any kind of calmness, and that's exactly what we saw yesterday.
Matt, I'm with you that the Fed yesterday cut risk when it had to do with credit, when it had to do with the credit cycle, when it had to do with the economy turning downward. I didn't get the sense that they cut risk when it came to inflation. And inflation over a longer period of time, given that they are getting back on team transitory, and there is this sense that it is going to be a one-time price shock, and down the line, there won't necessarily be ramifications, whether it's tariffs or whether it's not. That's the one kind of fly in the ointment that we've been talking about. Is that accurate? Does that really reflect the releveraging that we're seeing around the world, as well as some of the price pressures that are coming from other places?
So I think your interpretation is 100% correct. The way I would think about that as credit investors, now we're total return investors, but at the end of the day, we are credit investors. Inflation is not the worst thing to credit investors. The economy going into recession is. So that getting lesser of a risk, I think, is better for taking on high yield risk, bank loan risk, IG risk, EM risk possibly as well. Total return and what happens, with the long end of the curve. You actually saw the long end of the curve. It steepened. It was lower, but it did steepen yesterday. So, generally the market is telling you that we'll worry about inflation later. We just need to make sure that we're not immediately going into a hard stop. And that was the takeaway that I had yesterday. Clearly, again, we have a lot of hurdles coming up. I don't want to see an inflationary environment like 2022 all over again. But Powell got a little sassy with his comments around transitory, and he pulled out his Caroline Levitt yesterday, and he was basically saying, yes, transitory was different in 2022, but if you go back to the last time there were tariffs back in 2018 and 2019, it was transitory. So I liked his conviction on that. That gave me a little bit of confidence, and I like to see that side of him. That was pretty good.
It certainly hit a nerve. The only thing I would push back to this time around versus Trump 1.0 is that we were talking about tariffs in 2019. It was about China. Now we're talking about the president and his policy proposals. It's about Canada, Mexico, the European Union, India. We're talking about everything under the sun, including already 20% tariffs on China. So isn't it harder this time, this environment, and can't the inflationary impact be bigger?
There's a lot going on, right? It's from a lot of different angles. It's really going to be difficult for the market to adjust and understand. And Powell basically admitted that. He said, I don't know that I can pinpoint what is transitory and what is not. And you're absolutely correct. With one country, one angle, it was kind of a little bit easier versus if you're getting it from 18 different angles around the globe. I think that will be a lot harder for him to look through. The good thing is, to me, if he believes that it is transitory, which I think he does believe that, and he sees the economy soften, he is going to cut. So that's the bottom line that I took out of yesterday, versus he's not going to be conflicted. He's going to have a very confident approach to it. And I think that's good for credit. Now, it may not be great for overall yields. We'll have to see. But over the near term, I do think that eliminates some severe tail risk to the market that might not have been there otherwise.
Hey, Matt, this was fun. Appreciate it. Thank you. Matt Brill there of Invesco. He was sassy yesterday, wasn't he?
He was on several fronts, yes. What would you write? Transitory? Did you just say transitory? I did just say transitory.
Pretty blunt, wasn't it? The press secretary's very sharp, by the way. I mean, I enjoy it. It's great. I enjoy the press secretary. I enjoy it when Chairman Powell's that way. But you do want a forecast from Chairman Powell. Like, none of this, what would you do? I don't care what the people in the room might do. I'm not interested in that.
In fairness, it is a little bit of a difficult situation right now to come up with a forecast, and I think he was reflecting that with a slight bit of, really, guys?
I love Mike McKee, but I don't want his forecast. I don't think Mike McKee wants to offer a forecast. Let's get you an update on stories elsewhere. Here's your Bloomberg Brief with Yahara Hacker. So, Yahara.
Hi, John. Amtrak CEO Stephen Gardner abruptly resigned as the Trump administration threatens to pull funding for mass transit systems. Gardner saying he stepped down to ensure Amtrak continues to, quote, enjoy the full faith and confidence of this administration. The successor has not been named. NVIDIA is reportedly planning to invest hundreds of billions of dollars in U.S.-made chips and electronics. The Financial Times reporting NVIDIA will spend around $500 billion in the U.S. over the next 4 years. CEO Jensen Huang also told the FT it can manufacture its latest systems in the U.S. through its suppliers like TSMC and Foxconn. And Tesla is recalling all Cybertrucks produced and sold in the first 15 months the truck was available here in the U.S. This is due to a safety issue with steel trim pieces that come loose because of an adhesive it says is susceptible to environmental embrittlement. Tesla estimates that 1% of the more than 46,000 pickups it's calling back have a defect. That's your Bloomberg Brief. John?
Yahara, thank you. Thanks for the update. Thanks for this morning. Up next on the program, we'll run you through the next 24 hours and the week ahead from New York City. This is Bloomberg.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Bloomberg has the Fed decision under surveillance with the fastest coverage and exclusive analysis, including Powell's press conference. Nobody covers the Fed like Bloomberg. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
37 minutes away from the opening bell. Equities softer here by 0.4% on the S&P. On the Nasdaq 100, biting into some of yesterday's gains. We're down by 0.5. Your trading diary, your week ahead is shaping up as follows. At 3:30 Eastern, President Trump signing executive orders after the closing bell. Earnings from Nike and FedEx. Friday, Fed speak from the New York Fed president, Mr. Williams. Look out for that. That's important. Sneak peek of next week, PMI data and consumer confidence still to come. Tyler Kendall joins us now from Washington, D.C. Tyler, the president doesn't stop. More executive orders coming later. What are you looking for?
Yeah, John, two big events today that we're watching. Later on this morning, President Trump is expected to address a digital asset summit in New York. It will be virtual from the White House, but it does mark the first time that a sitting president has addressed a crypto industry conference. We'll be watching there, and whether or not any of those EOs later on today could be related to the crypto industry. And then at 4 p.m. Eastern on the official White House schedule, there is an event related to the Department of Education. Our Bloomberg News reporting that he could be signing an executive order that would direct federal officials to start dismantling the agency. We should note that he can't do this unilaterally. It would take an act of Congress, but the White House so far has already started to pare back funding as well as staffing in the agency as it tries to slim it down, making good on a campaign promise to try to bring education back to the states. We should just quickly note it does raise questions about funding going forward when it comes to the education department.
Tyler, appreciate the update. Tyler Kendall down in Washington, D.C. It has been non-stop, hasn't it, for the last 2 months?
Absolutely nonstop, and 13 days is the big one, the Liberation Day, as the president was talking about yesterday. I'm interested to see what more tea leaves we get in terms of trade negotiations, because Kevin Hassett said him and the team, Howard Lutnick, Scott Bessent, already talking to countries about maybe them bringing their tariffs down in advance of this April 2nd.
I'm looking at this tea leaf. The EU is delaying its 50% proposed tax on whiskey, American whiskey, to get some of its other, negotiations ready.
It's happening.
It's happening. But also spirits. Why are they in the center? It's like whiskey, champagne. I don't like your teas.
Why are we touching wine?
It's important to people.
Right,
it moves the dial on the conversation.
I know, but it'll be...
Don't touch my champagne. Not for me. Equities on the S&P, negative by 0.4.
I've had your
tomorrow.
champagne. It's good.
Jack Caffrey at JP Morgan, Nouriel Roubini, Kate Moore, and a whole lot more. This is Bloomberg.
Welcome back to another special Miami Open update for Bloomberg TV and radio from Tennis Channel. Nick Kyrgios claimed his first tour win in 896 days as he got past American Mackie McDonald. The Aussie's been sidelined by multiple injuries and was forced to retire in his recent opening round match at Indian Wells. And don't forget, you can watch all the action live daily on Tennis Channel.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
DraftKings hit a milestone in the second quarter of 2024. For the first time as a public company, it turns a profit.
Is this a new era for DraftKings?
There's an inflection from when you're cash flow negative and you're operating off of equity raises from the past to when you're self-funded and you're cash flow positive and able to control your destiny a lot more.
You've had your first quarters of profitability now. Does that take pressure off? Does it increase pressure?
I think it increases pressure. I mean, once you start making profits, people expect you to make more, and all of a sudden you're valued on a multiple of those profits as opposed to the theoretical what could be. So very important, I think.
When you're cash flow negative, you've sold a vision of what the company should be working on, and you're very focused on working on that and delivering against that. When you've pivoted to profitability, the world of what you can work on is a little bit open, and there's a lot of different ideas, and it requires more focus than ever to make sure that you are prioritizing on the most important things that are going to deliver the most value.
DraftKings' solid standing in a booming sector gives them the luxury to play the long game. They're not under pressure to cut costs.
When you have really strong revenue growth, you don't need that. If you look at where we are today and where we want to be and where we believe we will be, the vast majority of the incremental EBITDA is not coming from any cost reduction. It's coming from increased revenue.
We don't feel like we need to cut costs because we're growing our revenue so much, we want to grow our revenue into our existing cost structure. And there's no need to reduce the cost as long as we're being efficient with what we allow our cost growth to look like.
Behind the bright lights and adrenaline of pro sports is an equally exciting world of negotiations and deal making.
That's what we cover each week on our podcast, The Deal.
I love the fact that you have, we say the cojones, but I can't say that in Bloomberg.
Maybe moxie?
Yeah, moxie. I'm Alex Rodriguez, former baseball player turned business executive.
And I'm Jason Kelly, a journalist at Bloomberg. Over the next couple months, we'll hear from all-stars like Billie Jean King.
Well, what should I learn? What should I do? I said, learn the business.
Jay Williams.
You're an asset, but how do you become the principal?
Paul Rabel.
We're going to be the league of digital, and that's why you're going to invest.
Adina Friedman.
I definitely am competitive.
David Rubenstein.
People don't come up to me on the street and say, let's talk about this private equity deal you did recently. No, nobody does that. They say, let's talk about the team.
And so many more.
You need to clap?
No, I didn't. Go.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
All right, futures back down this morning. 30 minutes until the start of the cash trade. I'm Matt Miller.
And I'm Shonali Bassick. Katie Greifeld is off today, and Bloomberg Open Interest starts right now.
Coming up, U.S. equity futures reversed earlier gains on doubts the Federal Reserve can significantly cut rates this year after Jay Powell said inflationary effects of tariffs should be transitory. NVIDIA will spend several $100 billion to buy U.S.-made chips and electronics over the next 4 years. CEO Jensen Huang told the FT, we go live to the GPU tech conference in the next hour, and the U.S. consumer is in focus after Darden missed profit and revenue estimates with fiscal third quarter earnings. The owner of the Olive Garden says the environment is challenging. Let's take a look at where markets are trading. Equity index futures are down on the S&P right now, more than 0.5%. NASDAQ 100 futures down 0.2%. This after a rally into the close yesterday on what was seen as a dovish Fed. Of course, the Fed did exactly what we thought they would in terms of rates, but they raised their estimates on inflation, lowered their estimates on growth, and you can see as a result the 10-year yield is moving down below 420 now. We've been watching this 430 level, and we have breached that and then some off 12 basis points. Some of the stocks that we're watching today, I mentioned NVIDIA. Its CEO told the FT it would spend hundreds of billions of dollars right here in the USA over the next 4 years, $500 billion globally through 2028. You can see the shares right now down 0.6%, but they could move as the GPU tech conference continues. We're going to go live to that conference later in the program.
Maybe good for the United States, but more money, really, for NVIDIA at the end of the day. We'll keep an eye on all of that. We're also keeping an eye here on Darden Restaurants, up 1.5%. They had reported mixed third quarter results, but reaffirmed its comparable sales forecast for the full year. We'll be keeping an eye on more consumer stocks as well this morning, but really we are talking about the Fed because it is getting a mixed reaction from investors, from economists. Take a listen.
When growth slows down, which is the stack part of stagflation, then the Fed should be cutting. The inflation side of the problem is that if inflation goes up, which was their forecast, then the Fed should be hiking.
If you're in corporate America and you hear that, what do? You stop spending and you hold all the capital you can. This is a very dovish Fed.
I think this was much more hawkish, and the Fed not quite going to one rate cut, but the number of people who are expecting one rate or less cut this year going up.
There's kind of clear elements of both of these here. I think the market's view is it's not as hawkish as was anticipated.
I think the risk coming into this was maybe we just saw one cut in 2025. We kept the two. But going forward, I think we should be baking in some widening credit spreads, and we would view that as an opportunity.
The top headline for me is, I can't believe Jerome Powell said transitory again. But this is really something that Scott Bessent has been calling for earlier this month. He said, look, if anything's going to be transitory, it's tariff-caused inflation because it's a one-time reset of prices. At least that's their theory. Still, I didn't expect the T word to be used in the press conference.
It is a little bit scary. I mean, this was a word that investors have hated. They were so frustrated with the Federal Reserve to be using this in the first place. Now it's back, to your point. But, you know, there is a silver lining. Even though they're seeing growth slowing and inflation rising, another scary scenario.
Stagflationary scenario.
Exactly, which is really a double-edged sword in a lot of ways. There are some notes of calm in this market. The VIX is still well below where it was last week. It was at 28 at its highest last week. It is now back to 20. And what you're seeing because of that is investors have been willing to buy the dip in some instances, maybe not so much this morning, but also you're seeing deals come back. You're seeing an IPO roadshow starting in this market with all the pains we've been seeing. It is actually kind of alarming to see that kind of confidence to go public in this market still. So you are seeing signs that investors are ready to start moving again.
Right, and the bottom line is the dots are still showing 2 cuts this year. So I think the market saw that yesterday as dovish, even if Farrow thought it was hawkish. Let's discuss market sentiment with Conference Board senior U.S. economist Yelena Shulyadyeva. She joins us via Zoom. And Yelena, I think it's very interesting that they didn't change, that the dot plot didn't change, at least at the median. 2 rate cuts this year, while they expect inflation to be higher than they previously forecast. Wouldn't they want to at least hold rates steady if inflation is still 80 points above their target 3 years out?
Well, they want to hold the rate steady for the time being. I think that's what we are going to see. The question is which way it gets resolved. Is it going to be weaker growth and hurting the labor market in the end, or is it going to be inflation? And the Fed seems to be telling us that they think that they're more concerned about growth. Look at the summary economic projections. They revised down GDP growth much more than they revised up inflationary projections. And you know what, Matt? I almost jumped out of my chair when I saw, when I heard Chair Powell saying transitory again. I totally agree with you. This was a very dovish signal for me, actually. And again, if you look at the summary of economic projections, you see that they revised up inflation much higher in 2025. But going further, they didn't really touch the inflation projections. I think that is also telling you that they think that tariffs may be somewhat transitory in nature.
How big of a problem does this create? Because if you're revising growth lower and inflation might be sticky, if not higher, stagflation becomes a significant fear. But what would it take to get into that scenario? Is it still very far away?
I think it's, the fears of stagflation are exaggerated. You have to have inflation expectations de-anchoring for that scenario to really take a hold. Yes, the developments, weaker growth and high inflation are stagflationary, but, unless you really lose, confidence in the Fed and what they can achieve with their monetary policy, stagflation is not going to be such a big thing. I don't think that's in the cards just yet.
Yelena, President Trump weighed in as he has said he believes he has the right to do. I mean, frankly, most presidents at least say this privately, what they think the Fed should do. But he posted the Fed would be much better off cutting rates as U.S. tariffs start to ease their way into the economy. Do the right thing. April 2nd is Liberation Day in America. Taking aside all of the extra drama that he added in there, what do you think would happen to the U.S. economy if the Fed were cutting rates right now?
Well, we really have to wait and see what happens on April 2nd and going forward. For now, and this is another word the Fed used, uncertainty. They used it in the statement, and Chair Powell reiterated it during the press conference. Uncertainty is weighing on growth, and we don't have to wait for the impact to transpire. It's already happening. So I think that, you know, uncertainty will shave off some basis points from growth this year already, and that is already taking place. Going forward, we will see what kind of tariffs they imposed, what the rate will be, and all the other details. But, you know, our estimates show that if you combine China, Canada, and Mexico tariffs the way they were advertised, that could shave off 1 percentage point from growth this year. But that will raise inflation as well. The bottom line here is that, yes, tariffs are inflationary, but at the end of the day, we think that slowing of growth and a lot of uncertainty in the economy will weigh on inflation down the road, and eventually the Fed will have to lower rates.
All right, Yelena, great to talk to you today. Thanks so much for joining us on Bloomberg Television and Radio. I listened to you this morning with Nathan Hager. Conference Board Senior U.S. Economist Yelena Shilyatyeva on the Fed. Let's take a look at what's going on with futures right now. Keep in mind, we had a rally after this, and really markets shot up after the press conference, during and after the press conference. The gain was far over 1%. We were through 57.10 on our way to 57.20 on the S&P. But now it looks like that relief, I guess, to the Fed's dovishness has worn off, and S&P futures are down 0.6%, NASDAQ futures down 0.75. Russell futures even worse. Obviously, the small caps need rate cuts more than anyone else.
Yeah, speaking of love needed, I want to look at some of the movers under the surface this morning. Tesla lower by about 1.5%, 1.6% pre-market because, of course, a recall of Cybertrucks in the United States. Tesla estimates that 1% of the trucks sold are at risk of losing pieces of steel trim along the exterior, which are joined by an adhesive. Tesla has recalled the Cybertruck 6 times since launching the pickup in November of 2023. And I might remind you, the stock now at $232. This was the stock in December at $480 nearly. And you actually have Dan Ives, known for being very glowing about the stocks that he covers, out with a note, Matt, that says that he should call it like it is, that Tesla is going through a crisis and that there's one person who can fix it, and that's Elon Musk. And the problem here is that, of course, that it has become so politicized as a company, and that has created some issues for its brand.
And it's interesting, right, because Dan Ives is typically fairly bullish, fairly bullish.
Just a little bit.
He has an outperform on Tesla, a $550 price target on the stock. So for him to come out and criticize the company and point out that, you know, Musk is Tesla, Tesla is Musk. These things cannot be separated, and that provides a real problem for investors is interesting to say the least. I want to also point out, while we're on the subject of cars and tickers with T, S, L, and A in them, Stellantis is moving down more than 4% now in the pre-market. The chairman of Stellantis, Johnny Alcon, was talking yesterday and drew a lot of attention for some comments he made about Italy, saying that tariffs will affect Italian production. However, Stellantis still is going to follow through with a commitment to invest 2 billion euros in Italy, 6 billion euros in orders from that country. So he says, you know, they're going to continue to see car production levels higher through 2026, even though tariffs impact the vehicles. I have a Stellantis.
You do?
Car in my garage. Yeah, I had Dodge
no idea.
Challenger Scat Pack wide body with a 6.4-liter naturally aspirated V8.
Wow. I don't know that much about my car, but I do have a Beamer, so I am now interested in cars. Anyways, we're going to switch from cars next. We're going to talk about NVIDIA, because NVIDIA CEO Jensen Huang has laid out a plan to spend hundreds of billions of dollars on American-made chips. Wish it was that easy for the car industry, but it looks like it's not going to be that easy for NVIDIA either. We're going to bring you more on that report next. This is Open Interest.
morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
In case you missed it on the China show.
Compared to a 10% tariff on Chinese exports to the United States, I mean, even the entire determination of the fentanyl industry in China is totally worth it.
I think this is a monumental moment for global AI development. DeepSeek was not only just make the products free, but also they released the entire research open source so you can see how they did it. This has forever democratized this current most advanced version of AI.
How do your students feel about their jobs prospects?
There are a lot of opportunities in this AI application fields. On the other hand, if you look at traditional manufacturing, I think the main problem is that there's a lot of mismatches between supply and demand.
Don't miss the China show live every weekday.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week.
Welcome to Balance of Power.
This is Bloomberg Television.
Let's get to high interest now. We'll look at what's making headlines around the world. Nike has lost 44% of its value over the past 3 years, and we may get another reminder why this afternoon. The Beaverton, Oregon-based shoemaker will post fiscal third earnings after the bell. Analysts project quarterly sales shrank 11%, which would be the biggest drop since the depths of COVID. The CEO, Elliott Hill, who took over in October, has been clearing out the ranks. The departures of the chief strategy and transformation officer, as well as the chief communications officer, were announced just yesterday in an internal memo. FedEx, Micron, and Lennar will also announce earnings after the bell. QXO has agreed to acquire Beacon Roofing Supply in a deal that values the distributor of roofing, waterproofing, and exterior products at $11 billion, including debt. The agreement ends months of back and forth between the two companies. It avoids a full-blown hostile takeover battle. QXO will pay $124.35 a share for Herndon, Virginia-based Beacon. That's a 26% premium to Beacon's closing price on November 15th, the last trading day before news of the takeover emerged. And NVIDIA will spend several $100 billion on chips and gears made in the USA through 2028 in an attempt to shift more manufacturing onshore in the face of tariff threats. The CEO, Jensen Huang, told the Financial Times this is part of a $500 billion NVIDIA will spend on electronics over the next 4 years globally. Right now, only a fraction of the company's highly prized graphics processing units are made in America at the TSMC factory in Arizona. Shonali?
And speaking of made in America, something interesting about this NVIDIA story was that Jensen Huang denied reports in this story that NVIDIA was involved in discussions to be part of a consortium with the likes of TSMC, according to the Financial Times, to invest in Intel. Now, Huang did say that they evaluate their foundry technology on a regular basis and they have confidence in Intel. You do see Intel, however, down in the pre-market trading as well as NVIDIA, which causes investors to really be very uncertain as to how this Intel plan is going to follow through, how these companies are going to work together in this grand American chip manufacturing story.
Well, if they're going to spend several $100 billion over the next 4 years, surely some of that could go to picking up some Intel assets if that company is indeed broken up and sold. TSMC wants to spend more. Obviously, a lot of these companies are announcing big investments in the U.S. to appease President Trump, right? He's trying to bring production onshore. The question is, how much of this spending was already in planning and has been kind of rebranded as Trump appeasement spending, and how much of it is actually new in response to the tariffs?
1,000%, and it's already priced in, and you could see that in the NVIDIA reaction this morning. Where's the new money coming from? That's what investors want to know. And where is that new money coming from? Even with SoftBank and Oracle, where are they going to get those hundreds of billions?
Yeah, I mean, if I'm an investor, no matter what kind of payoff, when someone says we're going to spend $500 billion, that concerns me just a little. I want to look a little bit deeper into it. That's a lot of money to spend. And I think investors are focused on that CapEx.
Yeah, and to get more on that, we do have a special edition of Bloomberg Technology live from the NVIDIA GTC AI conference. That's going to be at 4:30 p.m. New York time. Our own Ed Ludlow will interview top executives about all things AI, and he's going to grace us with his presence.
It's Quantum Day. They call this Quantum Day.
I love quantum.
I'm sure that you do, as a Star Trek fan. All right, we'll learn more about AI from Ed Ludlow later on in the hour as well. This is Bloomberg, and this is Open Interest. Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
All right, quick check on futures ahead of the opening bell. We see red arrows across the board, a turnaround from yesterday. We finished in the green on the S&P 500 at 5,700, and now we're looking at a drop about 0.6% on the S&P. NASDAQ futures down 0.75%. Russell 2000 futures getting hit even worse. Because of anybody, of those three indexes, right, the last is the one that needs a rate cut the most.
Yeah, and you know, I've made a decision this morning. my decision was that there were a lot of bearish sentiments in that Fed release because you're seeing the 10-year now not only below 420, you're seeing it 417. So that tells you investors are still worried about growth. We're going to see exactly how worried. We're going to bring in Katrina.
Wait, what was your decision?
That this was kind of bad news.
Ah, okay. Got it.
Bearishness. And you're seeing that in the trade this morning. We're not wiping out everything from yesterday, but we are lower. And Katrina Dudley, Senior Investment Strategist at Franklin Templeton Public Markets, joins us at the desk. And I know you're optimistic, which is why I started this way. If you have a market that is driving the 10-year yield lower, that has been happening because of growth concerns. And so with the 10-year 6 basis points lower this morning, it shows that growth concern still exists, doesn't it?
Yeah, but you're talking us into a recession, and that is the big danger here in the market, that we're going to talk ourselves into a recession. So let's talk about how do you manage in a situation like this. And it's so dangerous to manage by anecdote and those soft indicators and ignore a data-driven approach. And the data is coming in much more positively than you're making it out. So I am in the camp that let us not talk ourselves into a recession. Let's look at this as a correction and an opportunity.
So you're not worried then about tariffs slowing down growth and raising prices? Aren't you worried about, mass deportations thinning out the labor market? Aren't you worried that we didn't get the reduction in red tape that we were supposed to get?
So 60% of people are in the bearish category, which means of the 3 people sitting here, I've got 1 bear and I've got 2. So you're part of my data set that says this bearish sentiment is what is concerning the market. It is what is driving those soft forward indicators, the consumer lack of confidence, some of the business confidence numbers. But let's take it back to the data. Let's look at the February jobs growth number. It came in fine. If we look at some of the growth numbers, the inflation numbers have come in better than expected. So the data
This is what Powell was saying yesterday at the meeting. He's like, hey, listen, the data looks good. And the part he didn't say is, we're terrified about the future, right?
And so is the market. So when the market is terrified, what do you do? And the fact is that those opportunities where you've got so much volatility, if you look at the VIX and the highs that the VIX is hitting, if I look at that bearish sentiment indicator, it is firmly in bearish category. So the person who is going to make money in this market is the person who sits down and calmly says, yes, there's the tariff news, but am I going to be positive and look at the positive data?
Very quickly here, does this mean that you believe that the market has hit its lows?
I think we're very close to hitting its low and forming a bottom. I think trying to time the exact bottom is just too difficult a task. But you look at the market, the reaction that we're seeing going into today's open, I think we are so close to a bottom that we are in the camp that this is an opportunity. And I love the fact that both of you are bearish, because that is what consensus is. Consensus is bearish, and the people who are going to make most money are the people who are willing to be calm, confident, and step in.
All right, we're going to talk more with Katrina, get more on her investment strategy here in these choppy markets. We are less than 4 minutes away from the opening bell on Bloomberg Television. This is Open Interest.
would it mean for India to host the Olympics?
Heslinda, I don't think it's my dream alone. I think it's a dream of 1.4 billion Indians to see the Olympics being held in India. I think once sport takes over, the transformation will be seen, not only in the lives of the youths, but in the economy of our country. India is one of the biggest centers for digital usage, and 1/3 of the viewership of the Olympic channel comes from India. So India as a sporting market is huge.
Countries which have hosted the Olympics have always grappled with the issue of infrastructure, for instance. Building it is one thing, maintaining it is another. How can India do it differently if it were to host the Olympics?
So I think we're talking about innovation and sustainability. And I think the same holds for holding the Olympics. What if you look at a sustainable model? What if you look at refurbishing old stadiums, reusing what we have? So I think the move has to be a sustainable move.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern. Only on Bloomberg. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
We are moments away from the start of trading. This is Bloomberg Open Interest. I'm Matt Miller. We're looking at futures that are down and actually reaching their lows of the session. S&P 500 futures now down 0.2% of 1%. NASDAQ futures down 0.8%, and Russell 2000 futures now off more than 1% on concern after Jay Powell used the word transitory, concern that the Fed won't be able to cut rates as much as the market had anticipated. There's still two rate cuts in the median dot plot, but maybe people don't take that as seriously. Jay Powell has often said you shouldn't. At the NASDAQ, you got Logistics Health ringing the opening bell. A new issue there. They've lost about 12% since they started trading in February. Down at the New York Stock Exchange, JP Morgan ringing the opening bell, looking at the wall there, and they have announced a new inverse VIX short-term futures ETN. In case you're wondering, an ETN is this ETN incorporated in the United States, and the fund seeks to provide exposure to the daily returns of the S&P 500 VIX short-term futures points change inverse daily index TR, which they refer to as an index. So that's not confusing at all, is it? Here's the live trade. You have the S&P 500 down 0.75%, the NASDAQ off almost 1%, and the Russell 2000 off a little bit more than that. So at the beginning of trading, at least in the first few seconds of the day, we're losing almost everything that we gained at the end of the day yesterday. We were up about 1% on the S&P yesterday, and of course, it looks like this is accelerating, and certainly futures, with futures, that was the case. In terms of the stocks that we're watching, Tesla is one. It's a big laggard in the Magnificent Seven, down almost 1%. Tesla recalled all the Cybertrucks, and that's because there were some pieces that are glued on that could vibrate and come off while you're driving. And that's concerning, but they say it should only be 1% of the 46,000 Cybertrucks they've sold since November of 2023. Shanali, what are you watching?
I am watching Darden Restaurants. We're looking at it now up 6.8% at the market open. Listen, they had reported mixed third quarter results. The owner of the Olive Garden says the consumer environment is challenging right now. Now, remember, of course, a very significant staple here. We're looking to see if people are going out to eat still, Matt. If you remember in the most recent retail sales data, that was actually a negative read, but the companies are not showing it across the board yet.
Not only do I remember, but I'm preparing an ECAN look later on where we will focus in on that retail sales data. Right now, though, let's get back to the desk here. Katrina Dudley joins us again. She's back with us, Senior Investment Strategist at Franklin Templeton Public Markets. And Katrina, in terms of your longer-term view, we know that you're more optimistic than we are. How about tactically right now? How long until you feel comfortable going in and buying this dip?
No, I'm actually comfortable now.
Yeah.
I think you're representing a lot of short-term fears, and I think we do need to acknowledge what is being thrown at the consumer in terms of the news headlines, the tariff data, the Doge cuts, the federal, the cuts to federal budgets, which are impacting, private institutions. There's a lot of uncertainty there, and the soft indicators are reflecting that. But there's something else in the soft indicators that we're not talking about, and I do think it's really important. And this is the extreme partisanship that is impacting this country. And I think that that is actually a bigger driver of some of these more sentiment-based indicators, which is why we've got a divergence between the actual data and the sentiment.
But hang on, you don't think that's going away, right? We're not going to get any less partisan in the United States of America, are we?
I actually hope we will.
We all hope we will, but do you actually think that's going to happen?
But at the moment, do you think we can get more? That is the baseline. So the fact is that the current indicators already reflect this high degree of negative sentiment and extreme sentiment. And the fact is that it's going to get better.
This issue is something you might remember John Lewinson over at Diameter. This is what he said it was the next big risk for him, that you have investors reading partisan data and making decisions off of it. It is not the underlying fact. It is how people feel.
Right. If you look at inflation expectations, Republicans think there's no problem. We won't have inflation. Democrats think it's going to go up like a hockey stick. If you look at growth expectations, Republicans think we're off to the races in a new golden era, and Democrats think we are headed for a recession.
You couldn't have said it any better than we can, which is this idea that this partisanship is driving sentiment, which is why we need to go back to the data. So all I'm saying is that when we look at our bull-bear indicator, Wall Street's very driven by that bearish indicator, which is in extreme territory as well. So as I said, 60% of people are in that bearish camp. So we think that there's a lot of opportunity for the average investor to start buying the average
What
stock.
would turn that around? How do you make that 60% of bears turn into that 60%?
I think it's just some of those, it's actually just the negative news being resolved and falling away.
Tariffs.
So the tariffs get incorporated. Last time we had tariffs, actually there wasn't such a big impact. It was more about the fear of the news and that initial fear, and then when we actually got to the eventuality of them, it wasn't so bad. So it's going to be that transition that we see. It'll be the transition once we see how private institutions accommodate some of these changes to foundations and other organizations step in. So I think we're kind of at that peak fear, and for us, that's why we think that the market's close to a bottom, and we think there's an opportunity.
Depending what you want to buy, right? Because I want to buy Harley Davidson. Those prices are up like 40% since 2018. Tariffs all around. Let me ask you what you would buy in this market, Katrina. Like if I take my Doge dividend and go to you and say, please invest this for me. You just said the average stock. What do you want to buy?
So when we talk about the average stock, we're talking about the fact that if we look at earnings expectations on a 2-year forward basis, all sectors are actually doing well, and it's a much broader market. So that's why we talk about the average stock doing well. So when we think about technology stocks, you want to just go a little further down the market cap spectrum than say the Mag 7 stocks and look at purchasing some of those names. So that's what we're talking. We just think there's a lot more opportunity in the broader market than there is in the Magnificent 7.
Speaking of the broader market, you look at a day like today and that bearish read is still out there, Matt. Almost every sector in the S&P 500, barring utilities, is negative today. And we saw good earnings news, frankly. And so you look at the sectors that have been doing the worst this year. Consumer discretionary by far has sold off. It's down 14%. A lot of that is Tesla, fine. But even beyond that...
This is year to date, by the way.
This is year to date.
Take a look at one day, and you're going to see a sea of red there. Only utilities is gaining. Thanks, Joe.
But even on the year-to-date basis, one question I have is consumer discretionary has sold off so much that do you believe we've bottomed enough to even buy parts of the market that people are afraid of, the consumer sector?
So the consumer sector and spending there is really driven by the job outlook and people's expectations for jobs and retention. And that has been one of the changes that we've seen, that people are a little more fearful. And the cure of that is just time and employers' communication and messaging. I think at the moment, employers are a little focused on handling the tariffs, and that's generating this uncertainty, leading to concerns about the job number. Once we get through that narrative, I think people are going to be very comfortable in their jobs. We've got low unemployment, and those two things are going to start driving consumer sales. And that's well, maybe your Harley may not be cheaper.
I appreciate that. That view, right? And that's what we all want. I don't think people who are bearish want the economy to be bad and want stocks to go down. They would prefer that the tariffs work in their intended way and that the golden era drives us to growth.
Well, that is one of the benefits of tariffs, is this reshoring. And we go back to the average stock. You know, a lot of that reshoring benefits small and mid-cap companies. And so, you know, it is part of the narrative. It does take some time to start showing through in earnings. But as we look at that 2-year forward earnings expectation, that is part of the help, that reshoring of manufacturing.
Katrina, we thank you so much for joining us today, giving some balance to what has been a bit of a bearish market. That is Franklin Templeton's Katrina Dudley. And we're looking at some more movers on our radar this morning. Speaking of the consumer, Five Below is climbing on a strong outlook despite headwinds from tariffs. I am so interested in this because that trade down story should benefit places like Five Below, where maybe you find a charger or a kid toy there instead of maybe going to these more expensive stores.
Is what I'm after.
A toy for your child.
I went to buy, my daughter in the grocery store wanted a balloon. They had these fish-shaped balloons.
Did you tell her that inflation is coming back and it's not possible?
They were $13 for a balloon. I said no. FedEx reports after the bell. You saw FedEx on the board as well. Its shares are down in today's trade. Nike also reporting after the bell, and that could be, as I said earlier, it could be a tough quarter with 11% sales shrinkage there and a turnaround underway. But we will wait to watch Romaine and the close team go through those earnings for you.
Yeah, and coming up, we're going to give you another read on the consumer because Darden Restaurants had missed sales estimates, but the stock is the top gainer in the S&P 500 right now. We're going to take a closer look as to why next. This is Bloomberg Open Interest.
In case you missed it, on Bloomberg Crypto.
You have sell-side analysts taking a look at what you're doing and starting to compare you to Coinbase. Are you after their business?
Well, I think we compete in the general sense of offering crypto to customers, but also this is a nascent industry and not very many companies have entered yet. Even though Bitcoin has now been around for 15 years, institutions and other companies have been waiting for signals to enter the market.
There are a lot of financial firms that are looking to tokenize private funds also.
Yeah.
Are you in talks with any of them?
We're generally in conversations with anyone trying to do interesting things in the space. If I had to pick the biggest pain point, AI is like transforming everything. So I think it's tough right now if you want to be in the AI sector as a retail investor. There's relatively few options that you can actually invest in.
Don't miss Bloomberg Crypto live Tuesdays.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
And it's time now for our top calls, some of the analyst action that's in focus this morning. First up, the maker of Corona and Modelo beer is no longer a buy at Citigroup. It's downgrading Constellation Brands because of Hispanic consumer weakness and tariff risks. The analyst is also upgrading the maker of Sam Adams beer on growth expectations. Constellation still up, though, 0.8%. Next up, Carvana getting upgraded to a buy at Piper Sandler as it turns bullish on vehicle technology stocks. The analyst says that the sector can grow despite higher tariffs, and the analyst also notes that automakers, except for Tesla, should be avoided. Carvana up 5%. And finally, Southwest Airlines no longer a sell at UBS after some recent strategy changes. The analyst says that the move to charge for bags shows that the company is taking a whatever it takes approach to driving financial improvement. Southwest now up 0.7%, Matt.
All right, another stock that we're watching this morning is Darden Restaurants. After that turnaround in the shares, the owner of Olive Garden says it still expects more than $12 billion in sales this year. But Darden Restaurants, which also owns the Capitol Grill down on Wall Street and the Yard House in Scarsdale, reported mixed third quarter results. If you take a look at the Bloomberg Terminal ECAN function, which we lean on a lot here, you can see retail sales figures from the BLS. This is over the past year. If you click into that yellow box, which is the food and beverage service spending figures, you can see how dire the situation is from the perspective of the U.S. consumer. Here to talk more about eating out is Michael Halen of Bloomberg Intelligence. Michael, let's focus first on Darden specifically. Why do you think the shares are doing so well after the company missed its fiscal third quarter revenue and profit estimates?
Listen, man, they missed by a teeny little bit. Give them a break, Matt. You know, coming into the number, restaurant stocks have been taking a beating, right, with this down move in the market. There's been a lot of consternation about the consumer sentiment numbers, right? And we take issue with some of those. But, you know, everyone expected kind of a softer quarter. You know, same-store sales are up about 60 basis points. But the real news is that quarter to date, sales are up more than 3% for Darden as an enterprise. And it sounds like, you know, the Olive Garden, Uber Eats initiatives quickly ramping for them. And it's making up about 2.5% of sales now at restaurants that have had it for some time. Longhorn continues to outperform, and fine dining did a lot better than expected. So, you know, we're looking forward. The market's looking forward, and that's why the stock's up so much today.
What does it say, this particular company, about where the consumer is right now in terms of what they're willing to pay to eat out?
You know, I think it's a pretty good gauge because they have a wide range of different chains, right? They range from Olive Garden and Cheddar's, which has a pretty significant number of low-income consumers, to the high-end fine dining, Ruth's Chris and Eddie V's and chains like that. So I think that for that reason, it's pretty good. But at the same time, Darden has done a good job of pricing below its competitors since the start of the pandemic by, you know, maybe 600 basis points. And so for that reason, we came into the year expecting Darden to kind of outperform their peers, and they've done so to date.
So you say you take issue with some of the negative consumer sentiment numbers, Michael. We showed that ECAN function and food and beverage services spending seems to have gone down a lot. The consumer across the income spectrum has a lower bank balance than pre-COVID and higher debt than pre-COVID. Do you think we're being too bearish?
I do. I do. We think for a few reasons. I mean, first of all, survey data. I mean, if you read the Michigan Sentiment Survey, you know, it's become highly politicized. And then also survey data, you know, people often like to say one thing and do another, or as my friend Alan Hickok at BCG likes to say, people like to talk skinny and eat fat. So it's not, you know, the most important thing we look at. You know, credit card balances are rising still, but at a much slower pace than a year ago. The delinquency data is a lot better than a year ago. So yeah, I think tariff headlines have scared people, but when you really dig in, some of the CEOs that we've talked to said that the slowdown in January and February was kind of broad-based against all consumer types, right? And that, to us, that says it was more impacted by weather, which Darden credited about 100 basis points of their slowdown to weather, to a very bad flu season, right? Because we know high-income consumer balance sheets aren't worse than they were a year ago. You know, just a month ago, we were seeing all-time highs in crypto, home prices, and the S&P. Obviously, S&P's down, I don't know, 8% or so since then, but still higher than it was a year ago. So consumer balance sheets aren't a whole lot worse. In fact, that we think most of the balance sheets are better than they were a year ago. And that's why we're part of the reason why we're more bullish on restaurant stocks. Also, we're lapping a restaurant recession. Sales were horrible last year.
Michael, I appreciate it. We appreciate you joining us here on Bloomberg Open Interest. And I love your haircut. The whole thing that you've got going on. It's fantastic. Michael Hale.
Man, I save a lot of money on haircuts.
Of Bloomberg Intelligence. In the next hour, we get another read on the consumer with the CEO of Newell Brands, which owns Rubbermaid as well as Elmer's Glue. This is Bloomberg Open Interest.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything. Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
This is Bloomberg Open Interest. Let's get a quick check on what's going on in the stock market. We are just 22 minutes into the session right now, and the losses are not nearly as bad as they were at the open. The S&P 500 now off less than 1/4% at 56.62. The NASDAQ down even less, 19,700. The level on the NASDAQ. Small caps are still taking a beating off 0.5%. But when Katie's not here, who cares about small caps, right?
We care about small caps. We care. We just don't talk about them that much because they're indeed small. But, you know, let's call it a little bit of a give back. It's nothing crazy today after yesterday's surge after the Fed meeting. And we're going to turn now. Speaking of giving back, we're going to talk about the strategy session because the S&P 500 will end this year in the 6,500 range, according to a new Bloomberg survey of Wall Street strategists. So that's a little optimistic there. Christina Kino works with the MLive team, joins us now. We are looking at gains for the S&P 500 by and large when you talk to the strategy community, when you talk to investors. So what's going to bring us there?
Well, Sonali, I mean, I guess it's just kind of a flushing out of this negative sentiment that we're seeing in equities right now, right? I mean, we've already seen that 10% correction and kind of a rebound from that this week. So that's helping a little bit. And, you know, we're starting to see sentiment kind of bottoming out here a little bit. The question is kind of how investors are really going to take that Federal Reserve meeting from yesterday. Because initially the message was positive for stocks, right? The fact that, oh, okay, they're seeing growth slowing down, but not necessarily a recession, and this whole idea of the tariffs impact being transitory, initially taken as good news. But I think what people are doing this morning is kind of taking a look at the nuances of the Fed's outlook for its rate path. It's not actually as dovish as we thought yesterday, because if you look at the distribution of the rate outlook, that's looking a little bit more hawkish and not usually good news for stocks.
I wonder how important going through the nuance of the Fed press conference is to the markets now. You know, there are times when the Fed is everything, and there are times when I barely notice it unless I'm watching The Fed Decides with John Farrow and Tom Keene. So does it really matter that much to the market that the Fed did exactly what we expected the Fed to do yesterday?
Well, Matt, I mean, I think there are kind of signals to take from the meeting yesterday, but I think you're absolutely right. We're definitely in a world where the Fed is not the only game in town anymore for markets. I mean, that was definitely the case last year prior to Trump's second term. But of course, now we have the new administration. It's going ahead with policies that are very much game changing for the economy and therefore the stock markets. And so, yeah, I think there's a lot of kind of signals for investors to take from what's happening in policy, not just from the Fed, but also from the administration.
Christine, thank you so very much for joining us this morning. Of course, always keeping an eye on what's going on in the investor community.
Check out the MLive blog.
Check out the MLive blog.
MLIV Go on your Bloomberg terminal to watch Christine's work.
Now, I also want to talk about, Matt, with you, something else that's going on in the market. You're not seeing it on the tape yet because it's almost going to get there. It's not quite there yet. CoreWeave right now is doing a roadshow in the middle of this crazy market. I love to see it because finally you're seeing the ability for a company to maybe go public. And we have not been seeing it. You can list ETNs that nobody can pronounce, but you can't list a public company in this market. CoreWeave is backed by NVIDIA. And even though they are finally doing this roadshow, it's scaled back. They're going to be probably around $26 billion at the high end of the marketed range in value. They were trying to go for $35 billion.
Exactly. Yeah, so that's scaled back quite a bit.
Right.
Interesting. Almost a third of the valuation been lopped off. And you can see why, right? Investors until now have only been putting money towards these big mega cap stocks and not so interested in the smaller ones. That's why we haven't seen a lot of them come to market. Coming up the next hour, Barry Knapp joins us from Ironsides. We also get Prince Constantine of the Netherlands, as well as the CEO of Newell Brands. This is Bloomberg.
in Davos, you were asking a question of President Trump, and he didn't quite answer the question, and he asked you a question. So the question he asked you was something like, why are you not banking certain groups? What is the answer? I don't think he gave you a chance to really answer that question, but what is the answer to that question?
Well, first off, the Bank of America has 70 million consumer customers and millions of small businesses all over the country, all over the world. And so we bank everybody. But the real question was about overregulation, frankly. And so as you look, what's happened is because the interpretations of AML, Anti-Money Laundering, BSA, Bank Secrecy Act, KYC, know your customer, know your customer's customer. You know, there's a lot of burden upon the banking system to both report suspicious activity reports and do a lot of analysis. And we have to close accounts, so we can't tell people why we did it. And often we're told by authorities to close accounts. That creates confusion. Another area comes up in this discussion is in the crypto area where the regulator said you can't bank crypto operating companies, employees of crypto companies, et cetera. We are allowed to do, we bank everybody, but the operating company, they said that's a high-risk activity. Ask us for authority, and guess what? You would have never gotten the authority. So that came up as an issue. So at the end of the day, it's about getting these regulations right.
Middle East and Africa. Vibrant horizons, Middle East and Africa, for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
News on the Hour, sponsored by Progressive Insurance.
I'm Stacey Lynn. The DOJ has a noon deadline today to release more information about the deportation flights of alleged migrant gang members on Saturday. And now some of the Venezuelan nationals on those flights claim they were mistreated.
The attorneys say the men were sitting on the tarmac for hours in dangerous heat with no water, waiting to take off. They say officers taunted them. There was chaos with some deportees crying, frightened about where they were being taken to. Some were eventually pulled off the planes after a federal judge blocked the administration from using the Alien Enemies Act of 1798 to deport them. An appeals court will hear arguments Monday. Michael Wallace, CBS News.
President Trump is set to sign an executive order this afternoon to eliminate the Education Department. Josh Cowan is with the Education Law Center.
The Trump administration says they're just moving chairs around. They're getting rid of the Department of Ed. They're laying off all the staff, but all these important services and funds aren't necessarily going to be touched. We'll see.
To the Middle East now, where fighting has escalated between Israel and Hamas. There were deadly Israeli airstrikes in Gaza overnight. And the BBC's Yolan Nell reports Hamas has fired back.
Sirens warning of incoming rockets sent Israelis in Tel Aviv rushing to shelters this lunchtime. One missile was intercepted and no one was hurt. Hamas's armed wing said it was responding to the massacre of civilians in Gaza since Israel ended the 2-month-old ceasefire.
Powerful and destructive storms in the Midwest.
Hundreds of airline flights were canceled or delayed, and there's been extensive damage. The roof was ripped off a roller skating rink outside Indianapolis. Jerry Williams is the owner.
We're just standing in the office and they're watching, and the next thing you know, sheets of plywood were shooting across the parking lot. So we just got on the microphone, told everybody we needed them to head to the bathroom.
The National Weather Service says more severe storms are expected Saturday from East Texas to southeastern Kentucky. Jim Crisula, CBS News.
A suspect has now been taken into custody following a shooting at a hospital this morning in Troy, Michigan. A man was shot twice in the arm. He's in stable condition. For those inside the hospital at the time,
it was, scary at the time. The workers did a great job to make sure some of the other cardiac patients were fine, but we didn't really know what to do.
He hid with others in the back room under a desk. TikTok will start pushing out Amber Alerts to users' For You feeds. It'll use your phone's IP address, and if an alert is issued in your area, you'll get it in real time. Facebook has been pushing Amber Alerts to users since 2016. Instagram's been doing it since 2022. This is CBS News. A lot of well wishes for the Pope.
The Italian Postal Service has seen a huge increase in mail addressed to Pope Francis since his February 14th hospitalization. Some are simply addressed to the Pope at Gemelli Hospital. The pontiff says he's thankful for the prayers that he has received from all over the world. Postal workers sort the mail into big yellow boxes labeled Papa Francesco. Jennifer Kuiper, CBS News.
Justin Timberlake was heading to South America for the next leg of his world tour when he took over flight attendant duties.
Ladies and gentlemen, welcome to the JT Live 25 South American leg.
He went on to read the safety instructions.
A life jacket is located in a pouch at the side of your seat. To inflate the life jacket, pull firmly on the red toggles,
as the flight attendants demonstrated. Another video posted on TikTok showed the singer playing golf down the aisle of the plane and high-fiving some passengers. Stacey Lynn, CBS News.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, good Thursday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We are streaming live on YouTube, so head over to youtube.com, search Bloomberg Podcast Live, and that's where you'll find us. Coming up here, Michael McKee, Bloomberg International Economics and Policy Correspondent. He's going to give us the latest on some of this economic data we had today. Well, he heard from his Federal Reserve yesterday in Washington. Sandy Brager, Chief Client Officer at Aspirient, on her outlook for the markets. Hugh Worthington, Bloomberg Intelligence European rate strategist. We had the BOV kind of holding rates steady here. What we're going to see from the BOE and some of the other European central banks going forward. So we got a lot coming up in this hour. Right now, let's kick it all off with John Tucker and get a Bloomberg Business Flash.
All right, this Bloomberg Business Flash is being brought to you by Interactive Brokers. Trade over 10,000 U.S. stocks and ETFs, U.S. equity index options, U.S. treasuries, and more on your timetable. Learn more at ibkr.com/around-the-clock. After yesterday's Fed-inspired bounce, stocks now pushing higher. We're lower at the start. You have 7 of the 11 major industry groups in the S&P 500 up. Communication services and consumer discretionary in the lead right now. Accenture is the worst performing stock in the S&P 500. It is down 8.5%. The IT services company reporting its second quarter results. They're noting weakness in their margins. Best performer, Darden Restaurants, reaffirming their sales forecast for the full year. Julian Emanuel, meantime, at Evercore ISI says the market is definitely in a pullback.
The path of policy really is going to set the narrative in terms of whether the pullback has more to go or whether we think you're actually starting a bottoming process, let alone the fact something more sinister. The market, to be clear, is pricing stagflation right now.
Well, NVIDIA, among the most active, reportedly they're going to plan to invest hundreds of billions in the U.S. and U.S.-made chips and electronics over the next 4 years. This is a move that is going to shore up the supply chain. So shares of NVIDIA right now up 1.1%. And at the intersection of sports and business, this is a big one. It is what will be the most expensive NBA team sale in history. Sportico reporting. Tom mentioned it earlier. Group led by William Chisholm and backed by private equity fund Sixth Street, reaching agreement to buy the Celtics.
What?
This according to multiple people familiar with the agreement, according to Sportico. The Celtics.
Wow.
Yeah, I knew you'd be surprised.
Larry Bird was on that, wasn't he?
Oh, look at you. Encyclopedic knowledge
Oh, my
there.
gosh.
Hey, John, look at this. I mean, the group that owns it now, Steve Pagliuca and part of Bain Capital, he bought it for $360 million in 2002. That's a nice trade, huh?
That's
How about
remarkable. The most expensive sports franchise remains what? The Yankees. Oh no, well,
it's going to be in football. It's going to
be European football.
No,
So
it'll be the NFL. I mean, the Dallas Cowboys, I would argue.
I'm going to have to find the answer to that question next
Well,
to
just to add on, Mark
Yeah.
Lasry will be joining us at 4 p.m. today, so we can also cover
Awesome.
some
There you go.
sports there also.
Oh, you're going to be all over that.
And you're going to take the lead on that,
Yes.
I hope.
Sports is scarlet, but I'll take the lead on the ego. We're all set here. All right, let's take a look now at some of the stocks on the move today. We're joined now by Bloomberg's Natalia Knežević, Bloomberg Equities reporter. All right, Natalia, what are you watching?
So let's start with NVIDIA. As John mentioned, CEO spoke with FT. He said that the company will spend hundreds of billions of dollars on new chips, other electronics. The key takeaway is that the company is trying to move forward and make sure that supply chains are stable and the company will be able to produce more chips in the United States. What is interesting is the stock is relatively flat and it's getting more and more complicated for NVIDIA to impress investors and analysts. We saw huge outflows out of the stock across institutional investors. But I have to say that one group of investors keeps buying NVIDIA no matter what, retail traders.
Retails.
Every time they buy the dip, two stocks, not a huge surprise, NVIDIA and Tesla.
We hear that from Eric Balchunas when he comes in to talk to us about the ETF business, that their ETF flows continue to be positive. Even when the market was down 10% this year, ETF flows are positive. Small or individual retail investors are buying.
Exactly, but potentially one of the reasons why we don't see such a big impact from retail investors on NVIDIA stock is because their exposure to U.S. stocks is already at almost record high.
Yep.
What else are you looking at?
Yes. So one company from the retail sector, it's called Five Below. The stock is up by 7% today. This is a so-called specialty value retailer.
It's like a Dollar General, but similar, I guess.
Exactly. So they sell small things like phone cases, headphones, pet products.
It's a really good place to go when you're buying cheap stuff, but you want it to look a little nicer than Dollar General for your daughter's birthday.
Oh, that's how it figures in.
For
Okay.
me, at least. Anyway,
Yes.
go ahead.
So this is why it's interesting. We saw that results came above expectations, but again, it's getting more difficult for companies, especially retailers, to impress analysts. We saw 2 downgrades from Barclays and Morgan Stanley, and analysts are saying that huge headwinds we could see from tariffs. And again, it's guidance, sales, is not enough to, beat.
I mean, we're seeing that. I'm hearing that more and more, I guess I should say, as it relates to the retailers. Analysts downgrading the stocks because they say, I don't know what's going to happen on tariffs, but I know a lot of these retailers get a lot of their stuff from China, and I just know we kind of have a sense of where the existing tariffs are in China, and if anything, they might even go higher. I'm out of here.
Right. I mean, and even the companies that tend to be loved by folks that like retail stocks like Costco, there are also questions there too. Like in a slowing economy, that's going to get hit no matter what. Not even layering in any exposure to China, of which they might have very little, but nonetheless, that puts perspective for Five Below. What else?
Carvana. The stock is up today by 8%. That came after Piper Sandler analyst upgraded the stock to overweight from neutral. And this is why I think it's interesting. Analysts said that basically used car companies that sell used cars are kind of protected from tariffs because demand is local, everything is already here. And so analysts at the same time downgraded Stellantis, Rivian. So we see this big spike in Carvana, and you might be surprised, but on a 12-month basis, the stock is up by almost 120%.
That's a volatile stock all over the place.
Meme. Can we say meme?
Yeah, I guess.
There you go.
Yep.
All right, Natalia, thanks a lot. Natalia Knežević joining us, Bloomberg Equities reporter. Okay, let's get the latest on the jobless claims that came out this morning, as well as any eco data to talk about, plus the little take on Jay Powell yesterday. Michael McKee, international economics and policy correspondent, joins us now. So jobless claims like kind of steady here, and the Philly Fed business outlook wasn't terrible. How about that?
Yeah, that was the headline number was pretty good news in the sense that it was 12.5. More than the forecast 9.0, but last month it was 18.1, and we saw a big rise also in prices paid, which is what everybody's keeping an eye on in terms of inflation and the Fed. So it's mixed news at best. But the job market seems to be in good shape. 223,000 initial jobless claims. That's up from 220, so a very small increase. And the number of federal workers filing for unemployment benefits went down.
Really?
To 1,066 from over 1,500 the week before. So that is probably because people don't know if they're fired or not. I mean, they're fired, they're rehired, whatever, and then they may get severance. So it could be.
I mean, that's a real thing down there. We had a note from one of our Washington, D.C. listeners saying, hey, this is real down here. You know, they're getting, it's a real issue for the folks down in the greater D.C. area. And I'll be interested to see when it does show up in the numbers. But a lot of folks down there are rightfully concerned. What was your takeaway yesterday, Mike, from Fed Chairman Jerome Powell?
I think basically the message he was sending is that we don't have any idea what's going to happen. So we don't know what we're going to do, but we'll do the right thing, whatever it is. And right now, where monetary policy is a pretty good place. It's not really slowing down the economy too much, but maybe just enough to keep the pressure on inflation. And with the inflation numbers that we've had, it's an appropriate level for us. So we didn't have to move. We don't know how to move, so we'll just sit here. And, you know, everybody wants to know, what does it mean for the future? And basically what I was saying afterwards was take everything that Jay Powell said in his news conference after he said good afternoon and throw it out. Because it's not going to have any shelf life at all. I mean, he explained things, okay, but in terms of people on Wall Street trying to divine what's going to happen, nah.
Okay, but nonetheless, if we look at, say, the growth issues versus inflation issues, do we have a feeling of which way the Fed's more worried?
Fed is more worried about inflation at this point. It's going to be interesting to see. And this is one of the reasons you cannot put a lot of stock in what we heard yesterday, because inflation, we know the PCE is going to go up a little bit, and Jay acknowledged that yesterday. But the growth numbers have been strong, and we've been running ahead of potential growth for some time now. But the latest data have suggested that we are in a slowdown. Now, Powell alluded to that yesterday, but said it doesn't look like it's a terrible thing and we're falling off a cliff. But it is something to keep an eye on, because if the data collapse more quickly than anticipated, we'll see Fed action.
To what extent does the Fed listen to the stuff we listen to, like when the airlines come out and cut their earnings, or somebody like Kohl's cuts their outlook, citing the uncertainty in the marketplace? Does the Fed look at that soft data?
Oh, sure. They're looking at everything. And you mentioned airlines. The fact that people are traveling less suggests that consumers may be pulling back a little bit on their spending because they're getting a little nervous. And this is the time of year when you would start to see ticket sales go up, because people are starting to plan vacations. So that's something that the Fed definitely wants to keep.
But then you get Norwegian Cruise Lines, who get a pretty bullish outlook, and that's those crazy cruising people like Charlie Pellet. Yeah. That doesn't matter what's going on in the world. They're getting on their cruise, baby.
That is true. We're also watching, of course, business spending. Yep. And we had, you were talking about it a minute ago, a rather large businessman today.
Yeah.
You know what was interesting? You know what stock bounced on that news?
What?
Manchester United.
No.
Okay.
He just
Madison
really went
Square
there.
Garden.
Oh, yeah.
Because
Good
the
point.
Knicks,
Yep, good
the
point.
Knicks were valued until today at $6.1 billion, which is what the Celtics sold for. And
Yeah.
people will say, well, if the Celtics in a smaller
Sure.
market with less media are worth that, then
Okay.
the Knicks
That
are
makes
worth
sense.
more.
That makes sense.
Okay. It's the thing with the valuations on sports. I love that. Thank you, Mike.
I
Appreciate that.
noticed your enthusiasm for that story.
Hey, I knew that Larry Bird played for the Celtics, so let's
Yes.
not underplay
Nailed
my
it.
ability to go. And I also filled out my bracket, Tom Kane, just because you told me to. All right, coming up, we are going to be breaking down the markets as well as taking a look at the equity market, still kind of struggling for this direction.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash, and we're being brought to you by Oracle. Attention growing businesses. Oracle offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure. This is for new U.S. customers with minimum financial commitment. Offer ends March 31st. See if your company qualifies at oracle.com/Bloomberg. The data we got at the top of the hour is market moving. Sales of previously, let's just call them used homes in the U.S., okay? Unexpectedly bouncing back in the month of February. If you annualize this, it comes out to 4.26 million. That is a figure that has, again, given a lift to stocks. Some of the individuals, the home builders, for instance, they're higher. Pulte
Mortgage rates did come back a little bit in that period. You know, they did come down a little bit during that period, so maybe that helped.
Yeah, Pulte up 1.3%. NVIDIA aiming to spend billions of dollars to procure U.S.-made chips and electronics over the next 4 years. This according to the Financial Times. Basically, they're shoring up in the U.S., and they're going to shore up the supply chain. NVIDIA shares right now up 0.9%. That's among the most active. Also, always among the most active, Tesla. Tesla recalling all those Cybertrucks it produced and sold the first 15 months it's been on the U.S. market. Shares of Tesla, they actually have turned higher now with the rest of the market, up 0.2%. S&P 500, 20 points higher. That's a 0.4. 56.96 the index. The Dow up 162 points. The NASDAQ 197 points higher. That is up 0.5%. On the Celtics news, so I had to find out, because I asked the question earlier on the air and I didn't know the answer, the most expensive sports team right now. That would be the Cowboys.
Okay.
Somewhere over $10 billion.
NFL.
Gotcha. Is NFL the most expensive sport?
Yes,
Yes.
by far.
Okay.
Most valuable. Most valuable.
Even more though than soccer?
I don't know.
On a global basis?
I mean, my question had to do with the global sports team, and it
wow.
It was
Guess
the
who's
Dallas
coming up?
Cowboys that
Scott
came up.
Soshnick. He's the editor-in-chief of Sportico. Far and away, the folks at Sportico are the best in doing this kind of stuff, valuing.
Scotty is the best of the best in terms
he
of
and
sports.
Obi.
He also used to work here,
Evan
so.
Novi Williams. So those two guys were Bloomberg. Okay, they're coming up. Okay.
They're coming up, so we're going to break all of that down. In the meantime, let's take a look at the market and kind of what you do if we are going to be in a stagflationary environment for a little bit. If you believe that, how do you manage it? Sandy Brager is Chief Client Officer at Asperian. She joins us now from California. So if we kind of like flirt with this stagflation scenario, a little lower growth, a little higher inflation, how do you manage that?
Alex, we're not totally worried about stagflation at this point. We think the economy has been very strong for the last couple of years, and sure, it looks like it is going to slow in terms of its growth. So far, inflation has been stickier than anyone would like, but it should be in check. But in terms of portfolios and how we're working with our clients, who are corporate executives, family business owners, and entrepreneurs, we're still thinking diversification is really important. Volatility, regardless of stagflation or not, we think is here to stay, and having a very diversified portfolio makes a lot of sense, not only for the near term, but for the years ahead. And that's been a very different situation than what has worked best over the last 15 years, actually, if you go back, look back over your shoulder.
Sandy, what's a diversified portfolio for, I guess, your typical client? Stocks, bonds, all alternatives? Are they a part of that diversification?
They are, Paul. Yeah, we have a fair amount in stocks, and within the stock portfolio, we're tilting toward stocks that haven't done that well over the last couple of years. So we have a lot of value stocks, small cap stocks, and a large tilt toward international, which we think is important. On the bond side, that could be up to about a third of a client's portfolio. We're looking on the shorter end there because our clients are in the highest tax brackets. We like muni bonds a lot. It makes sense from an after-tax perspective. And then we have anywhere from about 10 to 18% of client portfolios, mostly in alternative investments. And these are liquid alternatives. And they might even include things like gold that have been doing really, really well this year.
What about European equities and sort of expanding on that? Does that rotation have legs?
We think so. It does look like Europe is about to spend a lot of money on defense. And just like the United States, there are a lot of shocks that are kind of rippling through the global economy. But we do like Europe. Valuations are generally lower. Looks like some interesting things could be happening in Germany. Otherwise, France and Switzerland are looking good from our perspective. And they've been doing really well this year as the U.S. stocks have been correcting down.
How about on the fixed income side, Sandy? What are you advising your clients here? We're looking at the 2-year Treasury, 3.95%. That's certainly a lot better than what we've had over the last 15 years. Is that okay, or do you take some credit risk?
We're not taking a lot of credit risk right now, Paul. We think that staying on the shorter term side of the curve makes a lot of sense. There's not a lot of extra return available on the longer term side of the curve at this point. But we do pay attention to the fixed income, and we are a little wary with clients, reminding them that there is risk in fixed income just like there is in stocks. So as we've experienced the volatility so far this quarter, some clients have been asking if they should be rotating more to bonds, and we don't think that's the case. We think having a fair amount of bonds in the portfolio with some interest rate exposure makes a lot of sense, but not going too far out on that curve.
Sandy, thank you so much. We appreciate that. Sandy Breger, Chief Client Officer for Aspirian, joining us via Zoom from San Francisco. Again, one of the really interesting stories out today on the Bloomberg terminals about the Boston Celtics, a consortium including STG Partners co-founder Bill Chisholm, who was actually originally an investment banker, Payne Weber, my old shop, reached a deal to buy the Boston Celtics for $6.1 billion. Just extraordinary. And you want to talk about the valuation of sports franchises, there's one place you have to go, and that's Sportico. These folks do some outstanding work there. Eben Novy-Williams and his partner Scott Soshnick. Scott Soshnick joins us here. He is editor-chief of Sportico. Hey, Scott, I'm a Knicks fan, but I recognize value, and boy, this Boston Celtics, they're getting a rich valuation, aren't they?
Yeah, they certainly are. It's the most ever paid for a professional sports franchise, topping Josh Harris's $6 billion purchase of the Commanders. And we all know the difference between the NFL and everybody else. So for this to happen in the NBA is quite extraordinary. And it's actually going to be a two-tranche deal. So this first tranche, we understand, is at a $6.1 billion valuation. 3 years from now, the second tranche, I think the rest of the 49% of the franchise that wasn't sold now, is going to be at a $7 billion valuation. So perhaps accounting for inflation, but at a blended 6.6, you can bet that Adam Silver and the NBA's other owners are very happy with this transaction.
All right, so dumb this one down for me, right? I would assume
I can do that.
Like, no, please do. All right, you got football and you got soccer, which they call football in Europe, but I didn't know that basketball was this valuable versus those other two sports.
Yeah, I mean, look at the media deal. First of all, they just re-upped with Turner and ESPN, a almost 3x deal from the last time. So the media rights are incredibly valuable. What you normally look at with these transactions are what's the media and what's the real estate. What really is surprising about the Celtics is all the ownership has is the team, albeit a tremendous brand. I mean, the Celtics brand in sports is premium, platinum, top tier. I get it. But they do not own the building. They are tenants in the building. It's owned by the Jacobs, and which own the family that owns the Boston Bruins. So you're really just getting the team. It's going to be really interesting to see now, how do you squeeze further value out of a roster that, yes, is a championship team, but is projected to lose about $70 million this year. So it's a high price to pay. It remains to be seen how they can squeeze some more value out of it.
Hey, what do we know about this Bill Chisholm? What do we know about this new buyer here?
Yeah, we don't know much about Chisholm. I mean, he grew up in the area, grew up a Celtics fan, watched them put the banners up. Larry Bird was his favorite player, went to Dartmouth. These are the things the Grosbeck sort of pointed out in their letter that we saw that he sent out to the ownership group announcing the transaction. But from a sports perspective, we don't have anything now. He was one of 4 parties interested. Another one of the parties, of course, was Steve Pagliuca, who's a limited partner in the group now. Pags, early on, he had made it clear he thought what a fair valuation was, and I don't think over $6 billion was it. So he did bid on the franchise, but he didn't approach this number. Thus, he's happy to sit it out at this point.
So no bidding war we're going to resume or anything like that?
Once you got to 6, there was an early feeling during the transaction that the NBA really wanted this to begin with 6. Twofold. You always want the prices to be going up of your franchise, keep the owners happy. But the NBA is also about to embark on an expansion process, whether it be Seattle and Las Vegas and or more. This sets a very high number for those 2 new markets. So everybody happy across the board if you're interested in NBA valuations.
And Scott, we know that for a lot of these sports teams, the real value or much of the value is in their media rights. And if you're a national sport like the NFL, you're in a great shape. If you're a regional sport like baseball, like hockey, those regional sports networks and the challenges they're facing because of cord cutting, that's an issue. How do you factor that in for some of these regional sports the kind of the weakness in the regional sports business. How do you factor that into valuation?
Yeah, certainly. If you rank them top to bottom, NFL, NBA, and then hockey and baseball. Hockey and baseball certainly they really need that local money, that local TV money, which has been disappearing on the regional sports networks, which we refer to over here as melting glaciers. So the national number is so high for the NFL, and that's just pooled. So there is no local. You don't air it that way. The NBA does rely some on local media money, but that national number is also so high. And the NBA, if you've been paying attention over the last few years, you'll notice they've been doing some microtransactions. You can buy the last 5 minutes of a game. You can buy pieces of games. They are very strong on social. They are very strong globally. These are really dominant brands around the world. Baseball just did a great job in Japan. Well, the NBA has a great market in China, Europe. So there might be something coming in Europe from the NBA in the near future. So if you look at the aggregation of eyeballs, it might not be people sitting down in front of the TV watching quarters 1 through 4, but you've got people's attentions. Now, the challenge for Adam Silver and his owners is I've got the eyeballs. How do I monetize it in a new media world?
Actually, that's a great question, because I was going to wonder, how do you squeeze value? And you mentioned the Celtics in terms of the real estate, and how do you then squeeze more value? So in general, how do you do that?
Excellent question. I mean, I can't answer that question until I know what the new ownership group is going to do. I would say that a global audience would be the place I would start for the NBA. You have new markets in the U.S. We mentioned Vegas. We mentioned Seattle. That will bring a high price point. Then you talk about maybe a European league, and then your eyeballs outside the United States. Basketball, unlike football, and you see the NFL is trying awfully hard to broaden its fan base outside of the U.S. borders. It is not happening as fast as the NBA. That is a big advantage. I'm not one that looks at the Twitter followers and the Instagram so much, but if you go check out the NBA, they lead the sports leagues in global eyeballs. That is certainly an area of focus for all basketball teams.
Scott, are you still a crazy hockey dad?
Oh, you know about this. Yes, I am. I am off to Madison, Wisconsin. Thanks for asking. I'm off to Madison, Wisconsin in early April for the Nationals. My son's team qualified. Woo-hoo. If I am not sitting in this office, which you see behind me, I will be in a rink somewhere in North America.
See, folks, Scott and his partner, Eben, used to work here at Bloomberg, and I'd see Scott in the hallways, and every week I'm like, where are you going, dude? And it's like Syracuse, Buffalo. I mean, just
I'll come on, and we should do Josh Harris and David Blitzer, as you know, are focused on investing in youth sports right now with their Unrivaled platform. Good move, because the two places I see people spending money irrationally, they're pets and youth sports.
Scott, we gotta go.
Scott Soshnick, editor-in-chief, Sportico, former Bloomberger, talking about this Celtics, $6.1 billion. How about that?
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Let's say data is in the driver's seat right now for stocks. And the data is pushing it higher right now. Existing home sales, used home sales in the U.S. exceeding estimates. This comes after yesterday. The Fed Chair Jerome Powell downplayed any of the economic concerns. This kind of backs that up. Right now, the S&P 500, 26 points higher. That's up 0.5%, 5701 on the index. The Dow Jones Industrial Average up 216 points. The NASDAQ 100 is up 111 points. That is up 0.6%. The movers right now in terms of index points in the S&P 500, you have Meta Platforms. That is up 4% right now. NVIDIA up 1.4%. Amazon.com 1.3% higher. And Apple shares, they're up 0.7%. Yelena Shaletova, the senior economist at the Conference Board, says, you know what, Fed Chair Jerome Powell was right yesterday when he said tariff-induced inflation may not last.
Slowing growth because of all this uncertainty in economic outlook will weigh on inflation going forward. So there will be a period of higher prices, but then ultimately slowing growth will weigh on inflation.
And afterward, the Celtics being sold at what will be the most expensive NBA team sale in history. Other teams are getting a boost, those especially that are public. Shares of Madison Square Garden Sports, the Knicks, they're pushing higher right now. MSG, the ticker symbol there, right now they are up 3%. We check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Pull it, Alex.
Thank you so much. I should point out that Mark Lasry will be on television at 4 p.m. He, of course, owns the Bucks, so Milwaukee Bucks, so we'll be talking
Are you
going to
be doing that interview?
Well, let's be honest. Scarlett Fu is going to be leading the sports part of it, but I will
Because I will definitely tune in if you're doing the interview.
I will be asking questions, to be sure. All right, we're also waiting for President Trump to speak virtually at a crypto summit. It's the Digital Assets Summit in 2025 based here in New York. We're going to bring that to you when it happens. In the meantime, the bond market, got to be honest, doing a whole lot of nothing. A little bit of buying across the curve. We saw strong buying yesterday, particularly in the front end. Ira Jersey, Bloomberg Intelligence chief U.S. interest rate strategist, joins us now. Ira, what did you make of that strong buying we saw yesterday and continuing a little bit today in that front end after the presser?
Well, I think it showed you that there were large portions of the market that had been caught short. I think that there were some people who maybe going into the meeting thought that there would be even a little bit more pressure on the inflation side of things and the Federal Reserve being on hold. But the preponderance of the information that we got was at least a little tiny bit dovish, or at least not very hawkish. Interestingly, and this is something that I thought was what was particularly poignant, was that the opening remarks were very neutral. And so when Jay Powell got up there, he didn't say anything that was meaningfully different than the statement. He actually said, risks were both ways, but he mentioned uncertainty so many times. And I think that's one of the big reasons why you saw that rally in the front end of the curve, like you noted, Alex.
So we're sitting here with the 10-year Treasury, Ira, at about 4.21% here. Where do you think we end the year here?
So I think we end the year not too far from where we are right now at around 4.4, 4.5%, which, the reason for that view is while there is a lot of uncertainty right now, if the market's able to muddle along and the economy's able to muddle along and not go into recession, then I suspect that we'll be in a situation where the market's going to be pricing for interest rate hikes come 2026 or 2027. So that means you probably get a little bit of a steepening of the yield curve. So 10-year yields go up faster than, say, 2-year yields, and that's how you get to that 4.5% on the 10-year. But broadly speaking, I think, and this is something that's played out certainly over the first 3 months of the year, is we thought we'd be range bound in 10s, and so we've probably seen the yield high for the year, and now we're going to try to find the low end of the yield, and that's probably closer to 4% than where we are today. But nonetheless, you're looking at a pretty tight range here for 10s. Most of the action, I think, will be in that front end of the curve as we price in and price out different magnitudes of interest rate cuts by the Fed.
Do you think the market is more dovish or hawkish than the Fed at this point?
I think the market is certainly a little bit more dovish than the Fed, and certainly if you look at the dots, saying that the Fed's going to cut twice, and the market's saying just about 3 times this year. Of course, that's changed a lot, and actually, I'm working on a note right now. We've pointed this out before, but we'll have something out tomorrow morning on this. If you go back the last 18 months and you look at what the market's been pricing, we've basically priced for rates to be cut all the way down to 2.5%, or only to 4%. So basically the market is in this will they or won't they attitude, and every single data point that comes in winds up adjusting by maybe half a rate cutter up or down just based on the strength of that data. And that's one of the risks that the Fed has, because being so data dependent really does require the market to adjust to every single data print.
The Fed has a dual mandate, price stability, full employment. Does one take the precedent these days?
Yeah, it seems like the Fed is basically the put for the Fed. So what would cause the Federal Reserve to cut interest rates more aggressively is the labor market. Back in 2022, 2023, it was all about inflation. That's really switched over the last 7 or 8 months, and now the focus really is on the labor market. And the labor market, it's not as strong as it had been, but it's also not particularly weak. Everyone's like, oh, 150,000 payrolls plus or minus, that's weak. Well, yes, it's weak compared to 300,000, but 300,000 was exceptionally strong, right? So if you went back to 2005 or 2015 and you said, hey, we're running at about 150 to 200,000 payrolls a month, everybody's like, hey, that's a great economy. That's exactly where we want to be. So I think we have too much recency bias in the way that people are feeling about the labor market. The labor market's fine. It's not great, but it's fine right now. And as long as it remains fine, the Fed could probably be on hold.
Do we feel that tariff inflation is transitory inflation?
Well, it certainly is. It raises the price level, but the risk is, and I think this is something that actually Jay Powell did a reasonably good job of describing yesterday, is does it raise inflation expectations enough to be that inflation expectations can feed on itself? And you do see that in some of the data. So, for example, in the University of Michigan sentiment data last week, inflation expectations spiked pretty dramatically. But you don't see that for example, in the TIPS market. The TIPS market still thinks that, yes, we're going to have higher inflation maybe a little over 3% in the near term, but it'll wind up going back down toward 2.25%, 2.5% in CPI terms over the following year. So, we have this, yes, spike, and then the market goes down, at least, and then prices go stabilize somewhat. That's what the market's telling you, but at the same time, the consumer is really ultimately what's going to matter, I think, to the Fed, and if those inflation expectations, get unhinged, and I think that's something that Jay Powell mentioned very clearly yesterday.
What is the Fed doing with its balance sheet, Ira?
Yeah, so they're not running off their balance sheet as quickly as they were. They slowed quantitative tightening again, down to about $20 billion a month effectively, $5 billion of treasuries, and all of the mortgages that run off, which means about $15 billion a month. The reason they're doing this, though, is because of the debt limit. So they're worried that bank reserves, which have been going up because of the fact that the government's been spending a lot of cash right now and reducing the amount of T-bills that are outstanding in order to comply with the debt limit, they're worried that all of a sudden, once the debt limit is increased, those reserves are going to plummet, and that's going to mess up the plumbing of the financial sector. So the Fed, I think, cut the amount of runoff just to try to ease those tensions. It's not going to work, quite frankly, because if reserves plummet very significantly, very quickly, that is going to create a hiccup in the funding markets, and the Fed's probably going to have to step in and do some repos and other things in order to kind of quiet the market and stem any fear that there's a funding problem.
Woohoo! Love me the repo convo. All right, we will definitely be dissecting that even more. Ira Jersey, Bloomberg Intelligence, U.S. Chief Interest Rate Strategist. All right, coming up, earnings after the bell. Nike, going to be huge. It covers so many different things. Nike-specific issues as well as tariff issues, global demand, consumer demand. Elliott Hill is Nike's new CEO. He's trying to refocus the company on sports rather than fashion. I don't understand that sentence at all. But can he do it, and how long until he returns to some sales growth? Poonam Goyal, senior U.S. e-commerce and retail analyst at Bloomberg Intelligence, will be joining us for more. Taking a look at the equity market, the Nasdaq up by about 0.8%, following through on that rally from yesterday. S&P up 0.6%. This is Bloomberg. Happy Thursday.
listening to Bloomberg Intelligence with Paul Sweeney and Alex Steele on Bloomberg Radio.
Happy Thursday, everybody. Happy Friday Eve. Alex Steele here alongside Paul Sweeney and John Tucker. This is Bloomberg Intelligence Radio. We bring you all the top news in business, economics, and finance through our lens of our Bloomberg Intelligence folks. They cover 2,000 companies and 130 industries all around the world. And one of them is going to report after the bell today, and that is Nike. Poonam Goyal is senior U.S. e-commerce and retail analyst at Bloomberg Intelligence. This is a leading question, but just how bad are sales going to be?
They're going to be bad. You know, they're going to be down low double digits, but that should be no surprise, right? Nike has been saying this. They already guided to it. So if they come down between 10 and 12%, it's okay. In fact, we need them to clear out inventory to really make sure that their fiscal 2026 is off to the right start.
Talk to us about the inventory issue at Nike, and then just kind of generally speaking through the retail chain that you look at.
Yeah, so across the retail chain, inventory isn't that bad right now. It's actually pretty decent. Retailers have a check and a pulse on their inventory. But at Nike, the issue is the product, right? They have a lot of product that just wasn't the right product, and they need to dispose that to make room for new product. So their issue is specific to them, and it's still going to take another 3 to 6 months for them to really, you know, start to feel like they're getting in the right place to bring new product in that can sit on the shelves in wholesale and in their own retail franchises.
So based on that, when does Nike return to sales growth that's sustainable?
We're looking at fiscal 2026. So this quarter, it'll be down low double digits. In 4Q, their fiscal 4Q, it'll be down even more is what they have said. So things are going to look ugly before they get better.
So when I think of, I don't know, just reliance on China, boy, your business, this kind of just the retail business, the apparel business, I think of, boy, that's a tough place to be if you're going to have some concerns about tariffs and so on. What is Nike saying about their exposure to tariffs?
So we already had the tariff exposure question come into play when Trump was president the last time. So since then, they've actually had meaningful diversification into other Asian countries and outside of China. So when I look at Nike today and even the other athleisure companies, the exposure is in the teens in terms of their sourcing from China. And that can be diversified further by taking the product that's made in China for China or to outside of the US regions. So putting it all together, there is an impact, but it's actually smaller this time, and I'm not as concerned about it just yet.
What would make you more concerned? Because the difference this time is it was very targeted in President Trump's first term, but now if we're looking at reciprocal tariffs, that adds a whole different layer.
It does, but think about how much we consume from other regions around the world, even China, if they did add a reciprocal tariff, does it impact the U.S. consumer as much, or does it impact the international customer? I think it's the international customer that may be impacted more. I think, when you think about the tariffs, what he did was add a 10% tariff and then an additional 10%. But the last time around, the tariff was 20%, 30%, depending on the category, so much more meaningful. The delta here is just several percentage points, maybe 3 to 5 percentage points if you do the math.
What are we hearing about the consumer these days, really just over maybe the past couple of months, Poonam? What are you hearing from your companies? We heard Kohl's last week kind of give a lower than expected guidance, but what are you hearing from your companies as they try to get a read on their consumer?
I think no one knows where the consumer is going, but everyone is coming out with a more cautionary tone. So they are being guarded in terms of, could spending fall as just tariff concerns, inflation concerns, just broad geopolitical concerns are surfacing, and the consumer is taking a pause, especially on discretionary purchases, right, where they don't necessarily need the products.
What companies are best positioned right now, in your opinion, in terms of their actual execution plus managing any headwinds that may come across from the administration and the economic outlook?
Yeah, I think the companies that will do well will obviously be the ones that offer value, convenience to the customer. So across the companies that I cover, I think the resale sector is pretty attractive because they do offer value and they do allow the customer to trade down into getting the items that they want at an affordable price. Amazon still stands out. They offer everything, and they give you the convenience that you want to get it the same day or next day. So it's still a company that we think will continue to pull share from the rest of retail.
What's the state of the American department store, Poonam?
They're still struggling. They're still trying to find their way. They've come a long way in terms of closing stores. They've closed a ton of stores, and now it's just about finding product that really meets the needs of that customer, and they're doing more private label, more exclusive brands. They're focusing in on beauty. They're focusing in on just categories that really resonate with the shopper. That said, Paul, they're still struggling. When I think of retail, the department store sector is still one that's very cyclical and one where the customer is pulling back from, especially the stores that are in B, C, D malls.
Yeah, those malls and stuff. But if you have like a really cool mall, I still want to go to the American Mall. That's the one in Jersey, right? That has like a...
No, yeah.
Yes, it's in the swamps of
But
Jersey.
doesn't it have like a water slide? And
They have water slides. You can do all sorts of things in New Jersey.
Yeah. See, I feel like that's where I need to go. Like, drop my kid off.
And they have a Ferris wheel.
Budget a lot of time if you're going there. It's big.
Totally. Yes. Well, that's how I roll. But
it's municipal bond finance.
Poonam hangs out
really
there.
Important. All right, Poonam, thanks a lot. Poonam Goyal, Senior U.S. E-commerce and Retail Analyst at Bloomberg Intelligence. All right, for our listeners in the U.S., here's a reminder. You can listen to us via satellite radio on Sirius XM Channel 121. Access the world's only global audio business network coast to coast 24 hours a day. Bloomberg Radio on Sirius XM Channel 121 is presented by Oracle. Stay tuned for the latest market news and industry research. The second hour of Bloomberg Intelligence starts right now as we take a look at a market with the NASDAQ losing a little bit of steam here, up by about 0.4%, but still continuing some follow through from the rally we saw yesterday, and the S&P up just 0.4%. Happy Friday Eve.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Thursday, everybody. Happy Friday Eve. Alex Steele here alongside Paul Sweeney and John Tucker. This is Bloomberg Intelligence Radio. We have a great show lined up for you. Laura Kane, as Ottawa Bureau Chief, will be joining us. Apparently, Mark Carney is going to call Canadian snap elections for April 28th, which happens to be my birthday, which feels important that we're having these elections.
What a turnaround for the Liberals in Canada. I mean, it's shocking, really.
Sure, but we were more talking about my birthday. But yeah, we can also talk about Canada, but that's fine.
How young is Alex? How shocking.
My mother's birthday is April 28th.
Yes. All right, there's a lot of things happening on that
April
special
28th.
day. Fiona Rutherford is Bloomberg Consumer Reporter joining us. She covers the alcohol industry, what the EU is doing when it comes to tariffs on U.S. whiskey. And David Kudla, founder, CEO, and chief investment strategist at Mainstay Capital Management, will be joining us. And Jason Kelly, Bloomberg Originals chief correspondent, on joining us on the brackets. All right, it looks now that we do have a feed of President Trump speaking at the Digital Asset Summit in New York.
2 weeks ago, we hosted the first ever White House Digital Asset Summit, bringing together many of the world's top leaders in crypto for a conversation led by our White House AI and crypto czar, David Sachs, who's a fantastic and very brilliant guy. That same week, I signed an order creating the brand new strategic Bitcoin reserve and a U.S. digital asset stockpile, which will allow the federal government to maximize the value of its holdings instead of foolishly selling them for a fraction of their long-term value, which is exactly what Biden did. He got a fraction of their value. We're ending the last administration's regulatory war on crypto and Bitcoin, and that includes stopping the lawless Operation Choke Point 2.0. Operation Choke Point went beyond regulation, and I mean far beyond. It was a form of lawfare through government weaponization. Frankly, it was a disgrace. But as of January 20th, 2025, all of that is over. I've also called on Congress to pass landmark legislation creating simple, common-sense rules for stablecoins and market structure. With the right legal framework, institutions large and small will be liberated to invest, innovate, and take part in one of the most exciting technological revolutions in modern history. It's so big, it's, I think, as big as you can get. Pioneers like you will be able to improve our banking and payment system and promote greater privacy, safety, security, and wealth for American consumers and businesses alike. You will unleash an explosion of economic growth, and with the dollar-backed stablecoins, you'll help expand the dominance of the U.S. dollar, and many, many years to come, it'll be at the top, and that's where we want to keep it. We only want to keep it at the top, always. I can already see that the energy and passion of the crypto community is the kind of spirit that built our country, and it is exciting to watch as you invent the future of finance. And right here, it's going to be right here in the USA, the good old USA. Together, we will make America the undisputed Bitcoin superpower and the crypto capital of the world. Thank you. Good luck. God bless America.
That was President Trump speaking in the Oval Office to a recorded address to the Digital Asset Summit in New York for 2025. All right, let's take a look at some of the stocks on the move today. We're joined now by, wait, John Tucker? Do I go to John?
This
Yeah, okay, let's go to John.
is the second day in a row.
I didn't
she's
call you
completely
Charlie
forgot
Pellet.
about me.
I didn't call you Charlie. I just didn't throw to you. These are
It's
very
a trend.
different things.
It's a trend.
It's a trend,
John
people.
Tucker, Bloomberg Business Flash. Update us.
Tech mega caps leading gains in the stock market today. Right now, the S&P 500, 23 points higher. That's up 0.4%. 56.97 on the index. The Dow Jones Industrial Average up 232 points. The Nasdaq 100, 74 points higher. That is up 0.4%. And it's the data today, I'm going to say, that's driving stocks higher. This morning, we saw U.S. existing home sales topping estimates. The jobs market, that remains fairly resilient. Part of the message that Jerome Powell delivered yesterday was that at the Fed meeting, the economy's in pretty decent shape, so this seems to back that up. But Greg Buttle at BNP Paribas says, you know what, after yesterday's Fed meeting, investors should actually fade any bounce like this in stocks.
We didn't get anything from the Fed that I think really changes the bigger picture for equities, but neither did we get anything that was negative. So, our view is that we could have a bit of a relief for equity markets this week as some of the positioning got very washed out last week. And I think the absence of anything negative from the Fed was really seen as a positive.
Right now, the S&P 500, the leaders, this is in terms of index points. Meta Platforms up about 4%. NVIDIA up 1.4%. Amazon.com up 1.25%. You have Apple, that's rising right now, 0.3%. So with the news of the Celtics, trying to find publicly traded NBA teams, not a lot, apparently. So the best one I can come up with is what Mike McKee came up with earlier, MSG. It's actually the Knicks and the Rangers. Rangers being a hockey team.
That I know.
Right now, we have those shares up 2.4%, MSG.
I've got another one for you.
What?
The Atlanta Braves. They are owned.
No, but I said NBA teams.
Oh, NBA. So I'm sorry. I wasn't. I'm saying professional team. Because you can buy the part of the Major League Baseball. The BATRK.
Okay.
The Atlanta Braves.
All right.
Cool.
Thanks a lot. We
All right.
appreciate you.
Very good. We really appreciate you.
You remember my name now?
Your
We
name
value
is,
you.
Is Tucker John.
Yes.
TJ.
John Tucker, thank you so much. We appreciate that. Alex Steele, Pulse 20 live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. Let's take a look at some of the stocks on the move today. We're joined by Isabel Lee, Bloomberg Cross Asset Reporter.
I'm looking at Tesla, but it's not really on the move. It's flat forward this morning. But Tesla recalled all Cybertrucks it produced and sold in the first 15 months it's been on the U.S. market. So it's really over a safety issue that it's having trouble resolving. So this is 1% of the 46,000 vehicles having a defect. So that's like 4,600. You have to admire my math there.
Yeah, really.
And they're saying pieces of the steel trim around the exterior of the truck has, quotes, embrittlement. And I mean, they said they'll replace all the panels and etc. But I feel like it's more about sentiment. You know, like if you have a Tesla car, you might be worried about whether it's one of them.
Well, that's what I was wondering too, though. How much of the move in Tesla stock is due to Musk and versus actual fundamentals? And it feels like when you talk to analysts, it's both. But it's just a matter of like what's going to continue, I guess, to move it. I'm not really sure.
We have Dan Ives, the biggest Tesla bull, or one of. We shouldn't really just throw around superlatives like that. But he's saying that he's acknowledging that investors are nervous because of Musk's involvement with the government and because he's stretched. I mean, you only have 24 hours in a day.
Yeah, we were talking to Ross Gerber, who owns the stock of Gerber, Kowalski and Associates, and he was like, Musk needs to get back to Tesla and do stuff, and I don't think he's ever coming back. Like, he was mad about that.
To me, it's always been, you thank Elon Musk on the way up because there were no fundamentals supporting you. And you begrudge him on the way down because it's all about Elon and the valuation impact that he brings to that story. So anyway.
Totally true, that key man risk. All right, what else are you watching?
NVIDIA. So there's a lot of news around the stock actually, but for now it's edging higher by 1.5%. We have the CEO calming investors, basically saying that fears about DeepSeek are misplaced. He said new types of AI models that produce more complex answers will only increase the need for computing infrastructure. We also have an exclusive by FT saying that they interviewed Huang, and Huang said that NVIDIA aims to spend hundreds of billions of dollars to produce U.S.-made chips and electronics over the next 4 years. So lots of good news there. But for something a little bit more ominous, let's look at the technical analysis. NVIDIA is forming a death cross. That's when the 50-day crosses below its long-term moving average, which is the 200-day. And usually when that happens, shares have fallen as much as 50%. And NVIDIA has just really been trading sideways since May 2024. So maybe, is the peak there? No one can tell.
I don't know, it just feels to me, again, not being an AI expert, that AI lift to maybe NVIDIA, maybe to the tech sector, maybe to the market overall, that's kind of played out. It just feels like to me.
And investors are just expecting more and more and more. Even when these companies beat, they didn't beat enough. So it's risky.
What else are you looking at?
Lastly, it's Darden. We have shares edging higher by more than 7%. That's the most intraday since December 19. Management said its implied fourth quarter guidance includes comparable sales growth above 3%. That's above consensus. And they also said that inflation levels are manageable, and they discussed ways in which they can mitigate a relatively limited tariff exposure. They stated about 80% of its cost basket is domestically sourced. So I had to look up what restaurants are under Darden, and it's Olive Garden, Longhorn Steakhouse, Bahama Breeze, Seasons 52, Yard House. They also have a fine dining restaurant chain, Ruth's Chris Steakhouse, Eddie V's Prime, and Capital Grill. I haven't been to any.
All right, so if you're outside of New York, New York's got the world-class steakhouses, but if you're outside of New York and in the middle of nowhere, the Capital Grill delivers.
Yeah,
Well, I mean, steak.
but the Capitol Grill down on Wall Street was like definitely a place to go and like meet your contacts and hang out. And that's in New York.
But I can't do that.
No,
I'm in New York.
I understand.
Yeah.
Maybe it's the budget way to do it. All right, Isabel, thanks very much. Really appreciate it, Bloomberg. Isabel Lee, cross-asset reporter from Bloomberg. All right, let's back to the news that Mark Carney is set to call Canada snap elections for April 28th. Laura Kane is Ottawa Bureau Chief. She joins us now. Walk us through how snap elections look like in Canada.
So Mark Carney does need to go to our Governor General, she's the representative of the King in Canada, and request that Parliament be dissolved and have her call an election. Now, it's largely perfunctory, I'm sorry to say, to the King in Canada, but it's a step that needs to be taken, but it's very likely she will say yes. And so then we'd be off to the races. So he is looking at setting an election day of either April 28th or May 5th. Now, one newspaper in Canada is reporting that he's leaning toward April 28th, but we are not sure about that just yet. And we are hearing that he hasn't made a firm decision just yet between those two dates. But those are the dates he's looking at, and he's certainly looking to capitalize on this momentum that the Liberal Party has been seeing in recent weeks since Justin Trudeau's resignation and since Mark Carney took over. Most polls have them in a real fighting position for the first time in years, honestly. It's a drastic turnaround from a situation where the incumbent government was extremely unpopular and Pierre Poilievre's Conservatives were absolutely surging in the polls.
So talk to us about how the polls or how the political landscape is reflecting the fact that, for better or worse, we seem to be in some type of trade war with Canada and the U.S. How's that being reflected in the polls?
That is absolutely the deciding factor in these polls. I think Americans need to understand that Canadians are furious. They are outraged, right? There's this sense of absolute palpable patriotic fury sort of surging through the country as people don't understand why Canada's closest ally and trading partner is attacking them in this way. Canada does have a trade surplus with the U.S., but that's due to the oil and gas that Canada sends to the U.S. at a reduced price, at a discount. So from Canada's perspective, it provides the U.S. with cheap goods. It's always been a reliable ally and a good friend to the U.S. And so for Donald Trump to be, not only adding tariffs to Canadian goods at a higher rate than those he's putting on China, but to also be making comments such as Canada should be the 51st state, people are infuriated by this. And they're looking for now a leader that they feel confident will be able to take on Donald Trump and win. So that's really shifted to become the ballot box question, whereas previously it was sort of the domestic affordability issues that were defining the U.S. election, inflation, house prices. Those kinds of things are extremely important still, but the most deciding factor in those kinds of things may well be the extent of Donald Trump's tariffs on the country, right? He could send us into a recession this year. So it has completely overtaken everything. And so I think one of the reasons you might see Mark Carney coming out a little bit ahead of Poilievre on that front is that Poilievre has some Trumpian tendencies, right? He likes to use nicknames, slogans. There are ways in which Canadians view him as being more aligned with Trump. And Mark Carney is also, he's currently the prime minister. He has the benefit of being in an incumbent position where, he was able to travel to Europe last week and shore up alliances with our closest trading partners and display himself as the kind of leader that Canadians are looking for. So that said, some polls still have the conservatives ahead, and some people may be, angry enough at the liberals after 10 years and think that the liberals put us in a position where we're weak in this negotiating position with the U.S., where we do rely on the U.S. too much to buy our goods. So there's definitely a real opportunity still for the conservatives to take this election.
Just to break in here for a moment, headline crossing Bloomberg Terminal, the U.S. is poised to extend Chevron and Venezuela oil deadline past April 3rd. This comes in reports from the Wall Street Journal that Chevron was aggressively lobbying the Trump administration to extend that license to pump oil in Venezuela. So basically, Chevron's in Venezuela. The Biden administration let them continue to be on that despite issues with President Maduro. And leaving would also be difficult because not only do you have operations there and staff there, right? But you also have a certain type of oil in Venezuela that you don't have in the U.S. So that's another argument to be made. And oil executives apparently were in the White House yesterday talking to President Trump, focusing, so we've heard, more on permitting issues. But nonetheless, so that headline there is that Chevron, a deal to leave Venezuela, that oil deadline will be extended now past April 3rd.
Yep. All right. Very interesting. Hey, Laura, real quick here. What's the feeling of the average Canadian on the street in Ottawa? How is he or she thinking about the neighbors to the south these days?
It's not a warm, fuzzy feeling at the moment. Is that quick enough? I mean, I will differentiate, of course, from the American president and the American people, and I think most Canadians feel that way too. They have family in the U.S., friends in the U.S. We have been two deeply aligned countries for a very long time. But there are a lot of people who feel the relationship has been irreparably changed because of these 51st state and tariff threats. And people are canceling their vacations, they're trying to buy Canadian, and it's going to take a long time to repair this harm in a lot of Canadians' eyes.
All right. Well, thanks for joining us. We really appreciate that. Laura Kane, Ottawa Bureau Chief, joining us on the political situation in Canada, those potential snap elections, and also the loving, non-loving sentiment now towards the United States.
It's understandable, but I would tell a Canadian that those comments don't represent the majority of the U.S. population, but in all being accurate, I can't say that. I don't know.
Right. We don't actually know.
I can't imagine. It certainly doesn't reflect mine or a lot of people I know because we love Canada.
They have come up with an app, and it's one of the best, most downloaded apps in Canada right now. I think it's called Beaver, where you take your phone and scan the barcode on a product to see if it's U.S. made.
U.S. made, okay.
That's really
I love going to Canada. I mean, I love Montreal's great, Toronto's great, Vancouver's awesome. The skiing there is great. Whistler's some of the best skiing in the world, and the people are always so nice when you're there. I don't get it.
I don't know. Maybe not anymore for you? I don't know.
No,
I'm sure they'll be nice to you if you go.
Yeah.
They're not going to let him in.
They'll take my money.
That guy. I don't know.
But actually, saying that, I've traveled all over the world. Consistently, the most difficulty I have is with Canadian customs.
Really?
Canadian customs are very intense.
They're into it. I mean,
when I went there, and I'd never been to Canada, and I was traveling for work, and I was like, I had to fill out a form of like, why I was there, and like get my boss to sign off on it. It was really surprising.
It happens everywhere I go there. Vancouver, it doesn't matter where I go there. I'm like, am I on some list? This is back like in the 80s. Am I on a list somewhere?
He's definitely still on the list. All right, much more coming up. David Kudla, founder, CEO, and chief investment strategist at Mainstay Capital Management, will be joining us on the markets that are continually grinding their way higher a little bit here. And Jason Kelly, Bloomberg Originals chief correspondent, will be joining us for Brackets for a Cause. I filled out a bracket because Tom Keene told me to.
Oh, nice.
I did it. Don't ask me what I did, though, when I filled it out. I just put Texas for a lot. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker, the Bloomberg Newsroom. With this Bloomberg Business Flash, we're being brought to you by Oracle. Attention, growing businesses. Oracle is offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure. This is for new U.S. customers with minimum financial commitment. The offer ends March 31st. See if your company qualifies at oracle.com/Bloomberg. U.S. existing home sales rebounding in February. The weather improved. You attribute that. It's that kind of data that backs up the idea the economy is actually in pretty good shape, and that is pushing stocks higher right now. The S&P 500, 18 points higher. That's up 0.3% at 5694 in the index. The Dow Jones Industrial Average right now is up 183 points. That is a rise of 0.4%. NASDAQ 100 is just about 80 points higher. That is up 0.4%. We also have a NYMEX crude that's pushing higher, up 1.8%, 68.37 a barrel. Some of the movers right now in the S&P 500, the leaders, this is in terms of the index points. Meta Platforms 4% higher, NVIDIA up 1.75%, and then you have Amazon.com up 1.3%. And basketball and billions of dollars. And no, it's not just the Celtics we're talking about and their sale that we learned about today. The St. John's University men's basketball team won the Big East tournament for I can't believe I'm saying this, the first time in a quarter century. Of course, now they're focused to returning to the NCAA. The team's turnaround attributed to billionaire Mike Riepel, St. John's alumni, who has invested in the program, enabling it to recruit top players through the transfer portal. So money at work in sports, and it's not just the NBA, but it's also college sports as well.
It is.
College right across the river here. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. Alex and Paul.
I do have St. John's in my Final Four.
Do you?
Yeah.
Oh, and let me guess.
I feel like
Duke?
Yeah, they will not.
I mean, that's mandatory.
Yeah, exactly. But no, I got the Johnnies in there. You got to go on the momentum trade there. All right, John Tucker, thank you so much. We appreciate that. Alex Steele, Paul Sweeney, live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. You head over to youtube.com and you search Bloomberg Podcast Live, and we pop up there. John Tucker as well. S&P, as John was just reporting, up 22 points, 0.4% here. The market still focusing, it's seemingly in large part on some of the economic policies coming out of Washington, D.C. What do the professionals do here? How do they look at a market that had peak to trough pulled back 10%? David Kudla joins us. He knows what he's doing. Founder, Chief Executive Officer, and Chief Investment Strategist at Mainstay Capital Management, zooming in from the lovely Troy, Michigan, suburb of Detroit. Been there, done that. David, what do you tell your clients? Again, just a few days ago, we were looking at it. What was that technical correction in the S&P 500? What do you tell your clients when you see moves like that?
Good morning, Paul. Yeah, it's, this was a fast correction. Historically, in the time horizon that it went down, so it caught people's attention in that regard. What we like to think is we've educated our clients well enough that they know not to get too excited about 5 or 8 or 10 or even 12% pullbacks. And in this case, I think the difference here is there is an argument to be made that we've bottomed out and we're gonna climb back higher from here. I think there's an argument to be made too, though, with the uncertainty about tariffs, with the forecast we have for slowing economic growth, inflation remaining sticky at a higher level, that we could see some more volatility here as we work our way through 2025.
So what do you, one of the concerns I think for some investors is that they say, boy, a lot of this weakness in the markets have been kind of a result of the uncertainty associated with some economic policies coming out of Washington, D.C., principally all the tariff talk and the back and forth. One could argue that's not going anywhere. Does that concern you that this might be a kind of a headwind for maybe a fairly long period of time?
Yeah, it's definitely a headwind for the markets now. I think that's what the 10% correction showed us. What does the market hate the worst? The single thing it hates the worst is uncertainty. And the way that tariffs have been rolled out and pulled back, it's been a little bit erratic. We know what the long game is that Trump and his administration are trying to accomplish, but it is creating enough uncertainty that, you know, there's a lot of anxiety within the market. That's why we think volatility increases, even if we don't have further downside from here in the near term. So, you know, that is a concern. That's why, you know, we look at how can we diversify away from U.S. stocks, not just diversify between growth and value or small and mid cap, but, you know, why opportunities abroad, like in Europe, look even better. Liquid alternatives we like to use in times like this, where we can use them in our portfolio as another asset class to help dampen volatility, not necessarily dependent on the indexes, either stock or bond. So those are the things that we start doing, you know, versus the last 2 years where, you know, I consider that really a raging bull market. We had a little over a 2-year period where the S&P 500 was up 70%. 2025 is going to look a lot different.
Yeah, and there is a narrative in the market that if more capital leaves the U.S. for Europe, that's going to come in many different forms. Capital leaving the bond market, capital leaving the credit market. Mag 7 is going to get hit even harder because that was all where all the real sticky money is. Do you see that as a real risk?
Yeah, I do. Good morning, Alex. Yeah, you know, we just saw a stat that hedge funds are, you know, now setting records for the amount of longs they have in Europe versus shorts in the U.S. We've been in that trade of moving abroad to Europe for a while. It's probably getting a little bit crowded now. We think it still makes sense. You know, Europe we have lower valuations abroad. We're quite expensive here in the U.S. Even with the sell-off, we're still historically expensive in our PEs and U.S. stocks. Europe and other foreign markets have lower PEs, lower valuations. And, you know, with this news of the fiscal stimulus that's coming in Europe because of President Trump pulling back from NATO, questions about what he'll do in Ukraine. Germany has a massive fiscal stimulus spending package coming up that's going to boost European stocks, even though the fundamentals weren't quite as good there as they were in the U.S., say just 6 months ago. You know, the landscape is changing, making Europe in particular in foreign markets attractive, and certainly this year more attractive than the U.S.
All right, David, thank you so much. We appreciate that. David Kudla, he's a founder, chief executive officer, and chief investment strategist at Mainstay Capital Partners. I want to welcome into the studio Jason Kelly, Bloomberg News, joins us here. David, a million things to talk about with you, but I've known you to pal around with some pretty heavy hitters in the sports world. Man, did we have a story here today with the Celtics being sold for a $6.1 billion valuation. The numbers just keep going up.
Unbelievable number here, Paul. I mean, so this is the highest price ever paid for a North American sports franchise. And what's so shocking about that, I think, is that the NFL is like the big daddy of sports, as you know. This is more being paid for the Boston Celtics than was paid for the Washington Commanders just a couple years ago. So $6.1 billion it's a record by any account, by any amount.
Is that bubbly? I mean, actually, I say that, but like I feel like every time we talk about a sports deal, it's like my only question: is that a bubble? Is it a bubble?
I mean, it feels really, really high, to be honest. I mean, and for context, the Phoenix Suns were sold 3 years ago for $4 billion. So, I mean, wow. I'm not that good. I'm not as good at math as you guys are, but that's a huge, huge jump. Now, listen, they're the Celtics. They're the winningest franchise in NBA history, but they don't own their own arena.
Yeah, that's big.
And by the way, the NBA is a really, really tough business. They have a massive payroll. This is not a highly profitable enterprise. And yet, scarcity value, all these other things come into play, and people want to own these sports teams.
All right, let's stick with the hoops discussion. BRKT Go brackets for all you Bloomberg terminal users. Get out there. You have until noon today to fill out your brackets. I'm all in. Alex is all in.
I did it.
Lisa Mateo is in.
I did.
Brackets for a Cause, Jason. Talk to us about that.
So Brackets for a Cause, this is the 10th year we've been doing this. This is a big charity effort that we do. Peter Grauer, our chairman emeritus, leads this effort. I help him out
Carolina
with it.
fan. I have to put full disclosure out there.
He's a huge Carolina fan. I mean, and there they are sneaking into the tournament.
So we just glare at each other when we cross each other in the hole.
And rightly so.
Yep.
Listen, you've got a lot to look forward to in this tournament, I think. Our participants, we are putting together a group, again, for the 10th year in a row. $1.2 million on the line. This is split between the men's bracket and the women's bracket. Everybody chooses a charity. They pledge $20,000. They pick a charity, and the top three in either bracket, their charities get all the money. So it's names that you guys know very well: John Gray, David Solomon, Dina Powell, Jenny Johnson, A-Rod, my partner on the deal, Carolyn Tish-Blodgett, just to name a few.
Okay, so let's pretend like I knew what I was picking.
Yep.
Who's favored to win, men's and women's?
I mean, it's interesting. We literally are still parsing the data right now to figure out who all our folks have. Duke tends to get a lot of attention. But Florida, the SEC is dominant this year. They have a record number on the men's side. On the women's side, you've got UConn, you've got South Carolina, you've got UCLA, you've got USC, all sort of
I
vying.
picked a lot of those on both sides.
That's good. That's good.
Yay.
Yeah.
Texas, no, not so much. I did Texas for a lot of stuff. Just
For the
I
men,
don't know.
right? Yeah, they lost last night.
Oh, okay. So that bracket was wrong.
Yeah.
Great.
Yeah.
Okay, whatever.
Sorry.
We didn't even get started yet. I mean, for the women's bracket, and I did the women's bracket for the first time this year. Yeah. Because I've been getting, like everybody else, I've been getting into the women's game and the rise in popularity there. And I kind of feel you can just kind of go to some of these top seeds because it's the women's game, while it's really exciting, isn't as deep, I don't think, right now.
I think that's right.
So I'm not sure I'm going to get an 8 or 9 seed getting there. So I kind of picked some of the winners. But the women's game has just exploded. Well, women's sports in general.
It has
Caitlin Clark. I don't know what it is, but
it's a whole variety of things. I mean, there's a lot going on around women's sports in general. The big sort of mega trend is, go figure, when they finally put these games, and women's basketball, the college basketball was really leading the way. When they finally put the games on TV, guess what? People watched it. And in fact, one of the things we're really watching from a trend perspective, from the media perspective, you'll certainly appreciate this, Paul, is last year the women's final was actually more viewed than the men's final in NCAA. So we'll see if that holds true. Obviously, Caitlin Clark has had a big effect, but there's a whole new raft of players coming through. Paige Beckers at UConn, Juju Watkins at USC are probably the two best known players. So if they get far in the tournament, which is likely, given what you just said, Paul, we expect a big viewership there again.
And for social media, I find these players on social media, they kind of pop up on my feed. And so then I'm like, oh, I'm going to follow this person. And then you kind of, before you know it, you're looking at box scores, seeing, how many rebounds she had last night. That's how it kind of works. Jason, thank you so much. We appreciate it. Jason Kelly, chief correspondent for Bloomberg Originals, joining us here in our Bloomberg Interactive Broker Studio. Brackets for a Cause, some good stuff there here as we get into March Madness.
Yep, BKTS, right? Is that what it is?
BRKT.
BRKT. Jason's laughing at me, but I did it. But if you just type in brackets, you'll get there. Putting it out there. All right, coming up, we are going to pivot and talk about the auto sector. Craig Trudell, Bloomberg Global Autos editor, will be joining us. So Tesla apparently recalling Cybertrucks after pieces of steel trim come loose.
I remember my first car, pieces would fall off all the time.
How old was that car?
1965.
Did you pay 40 grand plus for a new one? No. Okay, this is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom. This Bloomberg Business Flash. Stocks are higher right now, following more signals that the U.S. economy remains pretty solid. Of the tech mega caps, they are leading the gains. Now, the data we got today, sales of previously occupied homes, stronger last month than economists expected. And then slightly fewer U.S. workers filed for unemployment benefits last week than economists had forecast. Accenture, worst performing individual stock in the S&P 500. This is the IT services company. They reported second quarter results and then noted weakness in their margins. The best performer, the owner of Olive Garden, Darden Restaurants, they reaffirmed their sales forecast for the full year. Still, Evan Brown at UBS Asset Management says, you know what, a tariff-inspired economic slowdown is probably ahead.
Ultimately, you get this one-off shock in inflation. That's going to weigh on real incomes. It's going to weigh on business hiring decisions and CapEx decisions. And ultimately, the Fed, once they just start seeing a hint of that hard data weakness, they'll be more inclined to cut.
The S&P 500 right now up 17 points, a rise of 0.3%, 56.92 on the index. The Dow Jones Industrial Average is up 186 points. That's up 0.5%. And the NASDAQ 100 up 61 points. That is a rise of 0.3%. Publicly traded MSG, owner of the Knicks, jumping right now. It is up 2.5%. On the idea all the NBA teams are now more valuable, with the Celtics being sold for over $6 billion. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. Alex and Paul.
John Tucker, thank you very much. Alex Steele here alongside Paul Sweeney. And John Tucker, breaking news for you. UBS is exploring moving its headquarters unless the Swiss cut its capital demand. Now, apparently, Switzerland requires the bank to hold an extra $25 billion in capital. And UBS says they think the requirement would make it uncompetitive relative to global rivals and would face pressure from shareholders if it accepted a much higher capital requirement than normal in other regions. That proposal is due to go before lawmakers in May, but any change might not happen until before 2028. So there is a window for that to be compromised.
That would actually be a blow to Switzerland and Swiss pride, because they take great pride in their financial institutions, and you had UBS merge with Credit Suisse. So you already lost one of your big ones.
Yes.
And now if you were to lose this, it would be, so I think they've got, UBS has got the leverage.
So the Swiss bank would move out of Switzerland as what they're proposed? Okay.
Yeah, pretty much. I mean, money speaks, I guess, at the end of the day. Okay. All right, one story that we are watching, of course, is Tesla. That stock is lower today as a company recalls the Cybertruck after pieces of steel trim come loose. All right, joining us now is Craig Trudell, Bloomberg Global Audio's editor. All right, what happened here?
Yeah, so this is actually the second time that Tesla's had to do a recall for pieces of trim coming loose. And so it's maybe a little bit of a source of embarrassment, because it's one thing to have an issue pop up I think for all automakers, even the best ones, they occasionally will have recalls that are a tad embarrassing. In this case, to have it happen twice, granted it is a different part of the vehicle, but this truck, of course, was so sort of famous for Elon Musk's decision to clad it all in stainless steel, and apparently they're having trouble with the adhesives to keep that steel stuck to the vehicle.
Craig, generally speaking, what's the if I were to go to Consumer Reports, what's the general feeling out there in the auto world about the quality of a Tesla vehicle?
I mean, I think for the Cybertruck, it's really interesting that this is the 8th recall that they've done.
Okay, that answers it, I guess.
And to be fair, some of them have been, for minor issues. My favorite one last year, they violated a font size rule in the U.S. where, when you warn a driver that of safety critical data, you've got to do it in a large enough font, and Tesla, violated that. So. That of course is not a particularly, I guess it's not unserious, but it's, a relatively minor thing. Some of these fixes that they've made, they've been able to handle them via over-the-air software updates. But an issue like this trim defect, they will have to, have customers come into the stores or into the service centers, have a look at the vehicles, and in some cases have to do some repairs that will cost the company some money. And I think generally the reputation, I think early on for Tesla, there was a lot of noise within the auto industry about, this company makes vehicles with, big panel gaps. A lot of people didn't really necessarily care about that. And I do think, to Tesla's credit, they've gotten better on quality, but, recalls like this don't really help that reputation.
So Tesla stock down almost 2%, but it's not like it's been smooth sailing. It's been a really terrible few months for Tesla. What provides a bottom for this stock?
I think the Cybertruck has been something of a letdown for them, right? It's the one new vehicle that they've had really since the Model Y came out back in 2020, and so I think there were some hopes that this would be a big hit, and I think it's not really sort of delivered. I think the thing to look forward to if you're an investor is the redesigned Model Y that earlier this year. The company sort of released a look at the Model Y. It interestingly has, on the front end, it looks a little bit more like a Cybertruck in that it's got a light beam, running across it the way the Cybertruck does. There's some improvements on the interior, but I think there are some real questions about, is this enough in terms of, real significant updates and upgrades to keep up with a company like BYD, say in China. They made a lot of noise this week and turned a lot of heads with these claims about being able to charge your EV in 5 minutes. And I think there's a sort of creeping sense among investors that if you want to see sort of innovation in EVs, you really look to China and look to companies like BYD or Xiaomi as opposed to Tesla.
And that in and of itself, Craig, is a subject of discussion here. When you talk to the Western auto companies that you speak with, whether it's a Volkswagen or even a Ford or whatever, are they prepared to cede the EV market to China?
I mean, I think the fact of the matter is, it's already been ceded. If you count, battery electric vehicles and plug-in hybrid electric vehicles together, it's roughly 2 in 3 electric vehicles that are sold in China. And, I think Tesla, to its credit, is a player to be reckoned with in that market. But, in terms of who's the leader, it's far and away BYD. I think Xiaomi, is really getting a lot of attention, not just among media types like me, but, Ford CEO Jim Farley has really sung that company's praises. And he's not alone. There are other executives in the industry who I know really are watching what they're up to closely. It's sort of the Apple car that Apple, didn't manage to pull off, didn't manage to make. And I think there's a lot of concern within the industry about, just how much of a lead Chinese manufacturers and in Xiaomi's case, a tech company, just how much of a lead they've built.
When we take a look quickly at the valuations for all these automakers, particularly in the EV market, have we re-rated enough for the decline in demand and for the tariff risks?
It's a good question. I think a lot of the manufacturers have really been beaten down by the tariff uncertainty, and that's been a global story. I think Tesla is still, after this pretty significant decline since mid-December, is still an anomaly in the industry where they are valued at many multiples of anybody else, and so I think there's still hope among some investors and a belief that there's a reason to treat this stock differently, that Musk will eventually deliver on his claims about self-driving vehicles, and he's also, I think, emphasized the potential for Tesla to become a AI and robotics company, even more so than a car maker. But I think, in terms of what this company does in the here and now and what it makes its money on, it's cars, and that business is really slowing down.
All right, Craig, thanks so much for joining us. Craig Trudell, Global Autos Editor for Bloomberg News, joining us from London via Zoom. Again, talking about Tesla's got a recall of the Cybertruck. It still gets your attention driving down the road. You look at it and you're like, boy, that is different.
Especially the Cybertruck in New York City. You're like, really?
Exactly.
Okay.
All right.
All right, coming up, we're going to talk to Lee Klaskow, Bloomberg Intelligence Senior Transport, Logistics, and Shipping Analyst. FedEx earnings out in just moments after the bell. We're going to break down what to expect from that. This is Bloomberg.
listening to Bloomberg Intelligence with Paul Sweeney and Alex Steele on Bloomberg Radio.
Happy Friday Eve, everybody. Alex Steele here alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news in business, economics, and finance through our lens of our Bloomberg Intelligence folks, because they cover 2,000 companies and 130 industries all around the world. So Nike's up after the closing bell, and so is FedEx. So Lee Klaskow, as Bloomberg Intelligence Senior Transport, Logistics, and Shipping Analyst, joins us now. As with most companies, we're looking at the macro environment, and then we're looking at FedEx-specific issues. What's on your docket to what to look at?
Yeah, obviously, I know this might not come to a surprise for you, but it's really about the uncertainty about the global markets and demand, and obviously that's being driven by the talks of tariffs on, tariffs on, tariffs off, and just not knowing exactly what is going to go on, and also impacting companies like FedEx and UPS is also the de minimis exemption, which kind of reduces or allows companies to avoid duties of imports coming into the United States for goods that are worth like less than $800. So companies like Temu kind of really benefited from that loophole, and we were expected that that exemption was going to go away. Then they delayed that exemption going away. So there's a lot of uncertainty going on in the market. For FedEx specifically, I mean, it's really a company that's in transition. It's really trying to restructure itself to deal with the realities of its business, which is more, home deliveries versus going to a law office and delivering, contracts from one lawyer to the next. It's getting your coffee pods delivered at your doorstep. So, they really have to restructure that and lower their overall cost to deliver to make that business an attractive business for them.
So what are they working on specifically, Lee? What are you going to be listening to on the call today, specifically about FedEx and its model?
More or less, they've been really actively restructuring their networks. They have a bunch of initiatives underway, and we really want to see, the benefits of that. Those restructurings, and they're also in the process of combining their ground and express networks. They're doing it in Canada, and once that's successful, they're going to bring it down here into the United States. And what they currently do is they operate two separate networks, like one for their ground business and one for their express business. And obviously, this creates a lot of inefficiencies, which they're trying to get out to the system. They're also reducing the number of planes that they operate and changing the way they operate their air fleet to meet, like I said earlier, the new realities of the demands that they have. And they walked away from the business with the U.S. Postal Service. That's obviously going to be a headwind for volume. But again, we got to see how quickly they are restructuring their own network. They're also planning on spinning out their less than truckload business, FedEx Freight. They announced that, and the stock got a nice pop a couple months ago on that news. If you look at the chart today, it's down around 11% year to date, which is obviously underperforming its peers in the broader market. That spinoff is not going to happen probably, sometime either late this year or early next year. But what that will do is it'll really allow the company to focus on its parcel business. And also, LTL or less than truckload carriers tend to get a much higher multiple than parcel providers. And that kind of benefit is being lost in the larger organization because it's a small part of FedEx, even though it's the number one player in the United States.
How does FedEx stack up right now against UPS?
Well, both companies are kind of doing the same thing, meaning they're restructuring themselves. UPS is doing the same. While they don't operate two networks, they operate one network. They're trying to make that network a lot more efficient, and that is through automation. They're making a lot of investments. So, a package can go from point A to point B with very limited physical touch. And then also with the use of AI and other technologies, they're able to better move that piece of shipment, that parcel, into a truck that's better operated. So, instead of having to deliver it in 2 days, maybe they'll hold it for an extra day. It'll meet the clients, the customers, delivery expectations, but it also will be more efficient because they happen to be delivering that package to your house, and there's another package going to your house that day too, and that lowers their cost of delivery. So they're busy doing that. And the reality is we're really not going to see these benefits from FedEx and UPS until the volume environment is much better. Expectations for FedEx's express volumes are to increase by 1-2%. Pricing up 1-2%. Those are obviously it's below GDP expectations, so that's not great. So once we see like more normalized growth. And we really haven't had normalized growth since the pandemic. It's either been creamy highs or depressing lows, depending on what we're comparing them to.
All right, Lee, thanks so much for joining us. Lee Klaskow, Senior Transports, Logistics, and Shipping Analyst for Bloomberg Intelligence, joining us via Zoom from Princeton, New Jersey. Looking at the markets here, we're kind of hanging on to some gains here. I'm wondering what the next driver of this market is, and I feel like it's April 2nd. Maybe you can get a little bit of clarity on maybe the extent and the breadth of whatever tariffs do come along, and then people can then build for that. Plan for that.
Right, but then if it's reciprocal, then it's probably then used as a negotiation tactic, right? So will there actually be any kind of clarity? But I agree with you. Like, what's going to be that next catalyst, right? Like, even Jensen Huang couldn't really stabilize the equity market in the same way. So we got through the Fed. That did a whole lot of nothing. So, like, do we just kind of bide our time? Options expiries tomorrow, so maybe we'll see some volatility, but that's just going to be
That's for you, because you're on air at that time, right?
I am, yeah. It's around the open.
Fridays at that time, I'm done.
Oh my God.
Gosh, yeah.
Are you napping at that time?
I might be breaking out the Vespa. It's spring.
Really?
Yes.
Even if it's like rainy and like 50?
I know. It's the weather's not cooperating here.
This
so
is
I'll
on
have to play it
principle.
later. Yeah.
Looking forward to the picture of the Vespa. Do you wear a helmet on the Vespa?
I do. Absolutely.
Very smart. We like that. We appreciate that. All right. That wraps it up for me and Paul on this Thursday, on this Friday Eve. Coming up, Balance of Power with Joe Matthew is up next after this global news update on a day where the market's grinding higher, but it's, losing some steam here. The Nasdaq's now only up by 0.2%. S&P up 0.2. This is Bloomberg.
This is CBS News on the Hour, sponsored by Progressive Insurance.
I'm Deborah Rodriguez. President Trump's talking cryptocurrency today, doubling down on a pledge to make the U.S. top dog.
Together we will make America the undisputed Bitcoin superpower and the crypto capital of the world.
The president's comment in a call to a crypto group as his Trump Media and Techno Group plans a $179 million crypto-related investment. Mr. Trump is expected to sign an executive order today aimed at gutting the Department of Education. Correspondent Natalie Brand is in Washington.
A senior administration official notes that student loans and Title I funding for school districts with large populations of low-income families will not be touched.
Closing down the department entirely would require an act of Congress. The Taliban have released George Glesman, an airline mechanic from Atlanta, abducted during a visit to Afghanistan 2 years ago. CBS's Vicki Barker is at the foreign desk.
He's the third American to be released since January. Unlike the previous deals brokered by the Biden administration, this one reportedly did not involve a prisoner swap. The State Department says the deal was brokered by U.S. and Qatari negotiators.
A man convicted of shooting a woman to death during a home invasion 20 years ago was put to death by lethal injection in Oklahoma today. Prosecutors said Wendell Grissom picked up a hitchhiker, and the two men randomly chose to rob a home near Watanga, where the 23-year-old victim was visiting her friend, who was seriously wounded. Police in Michigan quick to take a suspect into custody after a shooting at a hospital in suburban Detroit this morning.
The 25-year-old victim shot twice in the arm by a fellow employee after an argument in the parking structure. The suspect then took off. A massive evacuation took place of hospital personnel and patients.
It was, scary at the time. The workers did a great job to make sure some of the other cardiac patients were fine, but we didn't really know what to do.
The suspect was eventually apprehended and now awaiting criminal charges. Charlie Langton for CBS News, Detroit.
Sold for a hefty sum, the NBA champion Boston Celtics.
The sale price, $6.1 billion, a record for a sports franchise in North America. The previous record was the $6.05 billion the Washington Commanders went for in 2023. Bill Chisholm, the managing partner of a private equity firm and a lifelong Celtics fan, is buying the Celtics from the Grousbeck family, who paid $360 million for the team in 2002.
CBS's Michael Wallace. Interest rates didn't stop people from plunking down money on homes last month. National Association of Realtors reports sales of previously owned homes jumped 4.2%. This is CBS News. New legal action involving Boeing and a whistleblower.
The family of John Barnett, known as Mitch, has filed a wrongful death lawsuit against Boeing. They blame the 62-year-old man's suicide a year ago on the aerospace company. He was a whistleblower who brought attention to Boeing's quality control struggles. Barnett, who worked for Boeing for more than 30 years, was found dead from a self-inflicted gunshot wound in his truck outside a hotel in Charleston, South Carolina. Jim Crisula, CBS News.
Revelations from a former First Lady on sleep.
What's ideal bedtime? Man, anytime after dinner.
Michelle Obama tells the Kylie Kelsey podcast the former president doesn't get it.
My husband teases me about how early I can go to bed.
Kylie, who's expecting her fourth daughter with retired NFL star husband Jason Kelsey, says she pushes it a little, all the way to 8:30 p.m. Deborah Rodriguez, CBS News.
From the world of politics to the world of business, this is Balance of Power. Live from Washington, D.C.
School's out at the White House. Welcome to the fastest show in politics as President Trump today takes executive action aimed at eliminating or at least reducing the size of the Department of Education. We're about to find out together here. You thought Congress was needed for that. We'll get the latest from Bloomberg White House correspondent Tyler Kendall. Also, insights from Capitol Hill with Kate Ackley of Bloomberg Government. NVIDIA investing in the homeland, reportedly set to spend hundreds of billions of dollars here to make chips in the USA. We'll discuss the implications with Bloomberg's Mike Shepard and analysis today from our political panel. Bloomberg Politics contributor, Republican strategist Rick Davis is with us, along with Democratic strategist Aisha Mills. So here we go again, starting as always on Wall Street with his view on the markets. Charlie Pellet from World Headquarters in New York. Charlie, how's it look?
Thank you very much, Joe Matthew. Indeed, good day from New York with the Dow, the S&P, NASDAQ all higher at midday. Stocks are advancing on signs the U.S. economy is holding up. A strong U.S. housing market reading boosted stocks this morning. That number crossing at 10 a.m. Stocks turned around, and right now we are in the green with the S&P up 12 now, up by about 0.2%. The Dow up 152, up by about 0.4%. The NASDAQ Composite Index up 43 now, up by about 0.2%. We've got the 10-year yielding 4.23%. Post-Fed, the 2-year 3.96%. Spot gold lower, little changed at $3,040 the ounce, down 0.2%. West Texas Intermediate crude back with a 68 handle, up 1.5%. And Bitcoin now down 1%, 84,545 on Bitcoin. So while it is an up day for the Dow, the S&P, and NASDAQ, investors certainly keeping an eye on any developments out of Washington. Jay Bryson is chief economist at Wells Fargo. He says one of the biggest challenges right now is navigating tariff announcements.
With tariff announcements coming and going, businesses like some sort of certainty, and it's really hard to plan right now in terms of capital expenditures. If maybe there's going to be tariffs, maybe there's not going to be tariffs. So that's kind of, I think, the concern is just the uncertainty.
Jay Bryson of Wells Fargo. NVIDIA shares pushing higher by 1.5%. NVIDIA aims to spend several $100 billion to procure U.S.-made chips and electronics over the next 4 years. That, according to the FT, will have a whole lot more coming up right here on Balance of Power. And briefly, Apple shaking up its AI executive ranks in a bid to turn around Siri. Apple right now up by 0.1%. Balance of Power continues right now. Back we go to Washington. Once again, your host. Here he is, Joe Matthew.
All right, Charlie, good to see you. Thank you, sir. Watching Wall Street from World Headquarters in New York, the voice of Wall Street and the New York subway. There is only one Charlie Pellet. You hear him every day here on the broadcast. Welcome to the Thursday edition. You made it to Little Friday, and a lot to happen today in the nation's capital. Thanks for being with us here on Bloomberg Radio, on the satellite radio channel 121, and on YouTube. Dial it up now. Search Bloomberg Business News Live. Unless you're already there, it's great to see you. We bring you that live stream every day from New York and Washington to bring you in the studio for the conversations that we're having here. Happy first day of spring. It even feels like it. 65 degrees here in the nation's capital as we approach full bloom. We'll be looking at full cherry blossoms around the tidal basin in just a week. I know you're packing your bags for the road trip. We'll see you when you get here. Maybe we'll have a couple things figured out by then. Maybe we'll be done with school. Because yes, on this first day of spring, it started at 5:01 a.m. Some think this could be the last day of school because the President of the United States is going to sign an executive order aimed at what some would say eliminating the Department of Education. If you ask the White House, the start of the dismantling of the Department of Education. President's going to have a room full of governors with him in the East Room around 4 o'clock. They're going to do this about 4 hours from now. But already we have heard from the White House Press Secretary Caroline Leavitt talking to reporters in the driveway about what exactly is going on here. Not shutting it down, a little bit different. Listen.
The Department of Education will be much smaller than it is today. As you know, the president's executive order directed Linda McMahon to greatly minimize the agency. So when it comes to student loans and Pell Grants, those will still be run out of the Department of Education. But we don't need to be spending more than $3 trillion over the course of a few decades on a department that's clearly failing in its initial intention to educate our students.
Yes, the wrestling executive turned education secretary, Linda McMahon, set to body slam the Department of Education. What will be the impact? We start our coverage with Tyler Kendall, of course, Bloomberg's great White House correspondent, who's actually with me at the table today. Before you head back over to campus, what's going to happen here at 4 o'clock and what's going to be left of the department?
Well, Joe, as you know, this has long been a campaign promise for President Trump. The White House's argument is that they would like to see more education authority brought back to the states. But we should also note that many education decisions, take curriculum decisions, for example, are already typically made on the local level. Now, to be clear, and you alluded to it there, President Trump can't unilaterally dismantle or abolish the education department. That would take an act of Congress. And if, let's just say, for the sake of example, Congress did have the appetite to do this, which doesn't appear it does, it would take 60 senators, 53 senators are Republicans. They would need to get 7 Democrats on board. So that feels very unlikely, which is perhaps why we're starting to hear this shift in rhetoric, although slight, from the White House, that instead this is going to be scaling it back here. Still, though, even before this executive order, we really have seen this administration already start to take that unilateral action, right? Last week announcing that they were going to cut the education department's more than 4,000 personnel workforce in half. And we're also already starting to see them cancel regional office leases, saying that they are going to pull back when it comes to those offices around the country.
Well, it's interesting. So we could be left with essentially the shell of a department. It still exists, but it's not funded by a lot, or at least they're not spending the funding that's allocated. Half the workforce, to your point, has been already laid off. But the funding here and some of the grants that we've heard about moving, and this is usually the first question, what happens to the Pell Grants? What happens to money for disabled children going to public schools in the States? I guess we have a closer answer to that now?
Right, that was the big question when President Trump originally announced during his first week in office. You'll remember from the Oval Office, he proclaimed that he was going to start immediately to take these actions. Questions about funding for, as you said, students for disabilities. Also, the federal student loan program was a big question.
Right.
President Trump had previously floated that those programs would be rolled into other agencies or departments. He had said Treasury could be one of them, the SBA. He said that the administrator there, Kelly Loeffler, was keenly interested in looking into this program. According, though, to Caroline Leavitt on the White House North Lawn, though, Pell Grants are going to remain inside a more slimmed down education department. Okay. It's unclear exactly what that would mean for those other sources of funding. I did pull something from our reporting. It indicates that the executive order will mandate that programs receiving any department funds cannot be used to advance diversity, equity, and inclusion programs. That's another important factor in this. Pulled the statistics last year. The Department of Education distributed $121 billion in federal grants across the country. It has a lot of broad responsibilities, but mainly when it comes to it, it is that federal funding that many of these states rely on.
It's really something. You know, Donald Trump said it himself. Remember in the Oval Office, he wanted Linda McMahon to work herself out of a job. Her job was to end up not having a job. Sounds like we're going to still need an education secretary if we're going to at least have some of these grants and funding opportunities as part of the department. It just will look like a very different place than it does now. 2,000 people out of work, maybe more are coming. We're still not seeing this borne out in the economic data, though, are we? The reference date, I guess, was carefully selected here.
Yeah, and the jobless claims today, for example, indicating that there is still this relatively healthy labor market, which is leading to those questions about when will we see the full DOGE effect. For example, we know that many federal workers did opt for that delayed payout that they're going to be getting until September 30th. Is that impacting how people are going into the labor market? There's big questions there about just how quickly will the DOGE, the federal workers cut, actually show up in that hard data that we are receiving. But to your point, it does appear that there will be still some semblance of a department based on how we're reading so far the messages from the White House. But it remains to be seen just how far-reaching an impact it really will have.
Optics today, I'm always taken by the optics, especially at the White House. He's surrounding himself by governors. Not a mistake, right? They're going to be in the East Room, by the way. This isn't like the Oval Office where they pack a bunch of reporters in the room and start yelling at each other around the fireplace. This is the Grand East Room. It's going to be filled with people, including Republican governors who support this idea. I'm sure Linda McMahon will be there. But this idea of returning it to the states, there's a coordination in the media effort there, right? You get the governors in the room for the optics, and then you put them out on TV to sell the message that this is, in fact, better for their states.
Sure, and we've seen this administration take that tack before, right? Many of the behind the DOGE efforts has been that he wants to work together with those Republican governors. You'll recall, of course, he had them all in the East Room a couple weeks ago to kind of lay out his broader plans when it comes to how he is trying to slim down government and bring them in to pick up some of what he has called a burden when it comes to running the federal government. Today, it would not be unsurprising if governors do end up going to Pebble Beach, going to the networks to say what they are expecting out of this executive order. But again, we'll have to see what sort of tangibles they actually do give us, because at the moment, much of education funding does come from the state level, and those decisions are made on a more local, even sometimes city-by-city basis.
Listen to you on Pebble Beach. Now you got